move into the mock exam paper issued by C Sri Lanka. What I did was actually, rather than shifting screens here and there, I have taken all the questions into the PowerPoint presentation itself, right? So then we don't need to move to the paper, PDF and the PowerPoint presentation, right? Okay. So as I mentioned, question number one, objective test questions. Now you need to do, you need to be actively involved in this discussion. So we have 10 multiple choice questions. So you need to do a couple of things. Number one, you have to identify what is the area in which this particular question is tested, right? Thereafter, you can try and give or provide your answer to the question. So in that way, we can make the session interactive as much as possible, right? When you are doing the, when you are putting the message in the chat box, make sure that it is visible to everyone, right? Okay. Right. So the first question. So 2 marks. Which one of the following would be classified as a liability? So first of all, what is the area in which this particular question is tested? Any idea? The area in which this question is tested? Hurry up. So it is tested from conceptual framework for financial reporting, right? So in the conceptual framework for financial reporting, it recognizes the elements of the financial statements. There are 5 elements: assets, liabilities, equity, income, and the expenditure, right? So it defines what each of these elements are meant, right? What is an asset, what is an liability? So here, if you look at, before answering to the question, if I look at, this is how the framework explains about the liabilities. I'm not going to take all the elements about the liabilities. What it says is it's a present obligation to transfer economic resource as a result of a past event. So the important point that you need to remember here is it's a what? Present obligation. At the moment, you have a duty or responsibility where you can't avoid, right? So the settlement of this duty requires you to transfer economic resources of the entity, and this particular liability is because of a, it resulted because of a past event. So for an example, let's say trade payable, bank loans are considered as liabilities, right? So now what do you say? Out of these things, which one should we classify as liabilities? Expecting an answer from you. If I go one by one, right? DPLC's business manufactures a product under a license. So they manufacture a product under a license. In 12 months time, the license expires and DPLC will have to pay 50,000 rupees for it to be renewed. Now, do we have a present obligation here? So the license would expire in 12 months time. You need to pay 50,000 rupees at the time of renewal, right? So do we have a present obligation? At the moment, I don't have any obligation, right? What if I don't renew the license in the future? So I even can say that I'm not going to renew. So there you don't have a present obligation, then it is not a liability. So the answer A is incorrect. Answer B, CPLC purchased an investment 9 months ago for 120,000 rupees. Market for these investment has now fallen and CPLC's investment is valued at 90,000 rupees. So what is it actually? This is a financial asset, right? So made an investment. So at the time of making the investment 120,000, now the value of the investment has come down to 90,000. So you have to recognize, if it is measured at fair value, you have to recognize the fair value loss, right? So but this is not a liability yet again, so it's a loss. So you have an asset, you have a financial asset on one side. On the other hand, if this asset, if this asset is measured at fair value, you have recognized the loss of 30,000, but yet again you don't have a liability here. Am I correct? Right. Then answer C, BPLC has estimated tax charge on its profit for the year just ended, which is how much? 165,000. What do you say? So you have conducted the business, earned a profit, and on that profit you have to pay a tax amount of 165,000 rupees. It's a present obligation. You have to pay this to the inland revenue, right? It's a present obligation, and you know, you have to pay that by using your economic resources, by using cash, right? Why you have this obligation is you have made profits, right? So this is actually a what? A liability. So actually the answer for this question is answer C, right? Answer C would be the correct answer. But if you look at the answer D as well, expansion is planning to expansion is planning to invest in new machinery and has been quoted a price of 570,000 rupees. Future expansion, future capital expenditure, right? You are expecting to do an expansion in the future. So are you going to recognize this as a liability now? Again, you don't have a present obligation. It's a future capital expenditure. When you incur the expenditure, you recognize, you capitalize it. You don't have a liability. So what is the correct answer? Correct answer is answer C, right? So I have a correct answer here, right? Nilanki has given the correct answer. So answer C is the answer for the first question. Right. So let's move to the second question, right? Let's move to the second question. If you have any questions, any doubts, you can clarify by putting that in the chat box and ensure that it is visible to everyone, right? Okay. Then question number 2, right? You have to do these two things, what I mentioned. Number 1, in which area this question is tested. And second thing, most important thing, what is the correct answer? Right, what is the question? Which of the following would correctly describe the net realizable value of a 2 years old asset? So what do we need to explain? Describe the net realizable value of a 2 years old asset. Right, so tell me, what is the area in which this question is tested? Hmm? Why the area in which this question is tested? Yet again, what? Conceptual framework for financial reporting, right? You can say that it is from inventory, no. So basically, conceptual framework for financial reporting explains different measurement basis that the company can use when preparing the financial statements. It can be the initial measurement, it can be the subsequent measurement. So in the framework, it identifies mainly there are two main measurement bases are available. Number 1 is at historical cost. Number 2 is at current value, right? Then this historical cost, all of us know. So how much we have paid at the time of giving the rise to the item, how much of an amount that we have paid, historical cost. And you take cost, if it is a depreciable asset, cost minus depreciation, right? Then when it comes this concept of current value, so under the concept of current value, there are three measurement bases discussed in the framework. Number 1, fair value. Fair value means the market value. So there's separate standard to discuss the fair value. What is that? SLFRS 13. There's separate standard. It discusses about the fair value measurement, right? So I'm not going to define what it is. So it discusses entire thing with regard to the fair value measurement. Then value in use. What is value in use? Present value of the future cash flows. So if you have an asset, what are the cash flows that you can generate out of this asset? Discount these cash flows and derive the present value. That is value in use. Current cost means it is actually the replacement cost. Let's say I have an asset which is 2 years old. If I need to put up this asset today, how much do I need to incur? What is the replacement cost? So out of the replacement cost, you deduct the relevant depreciation to derive the current value. Okay. So, but the net realizable value is not defined here actually. Under the historical cost or under the current values, it is not defined, but we know that in certain standards, like as one student correctly mentioned, right? Shamil has correctly mentioned. So in the inventory valuation standard, you discuss this concept of net realizable value, right? So we know that under LKS2, inventory has to be measured at lower of cost or net realizable value. What is net realizable value? Estimated selling price minus estimated selling cost minus estimated cost to complete, right? Okay, now let's move to the question and see what is the answer is. So what is the question? So what is this out of these four answers? Describe the net realizable value of a 2 years old asset. original cost of the asset less 2 years depreciation. What is this? Historical cost. This one is historical cost. Right? So then B, amount that could be obtained from selling the asset less cost of disposal. Actually, this is the net realizable value. Okay, NRV. So estimated selling price minus the cost to dispose. So this should be the correct answer. But let's look at the other two as well. Cost of an equivalent new asset less 2 years depreciation. What is this? Replacement cost. Okay, so this is the current cost or the replacement cost. I would say current cost. If I need to uh, buy an equivalent asset today, how much I need to spend minus the depreciation. If I need to buy a 2 years old asset, how much would be the cost that I need to incur? Current cost, or else this also can be say that replacement cost, right? Then part D, not part D, answer D, present value of future cash flows obtainable from continuing use of the asset. What is this? Present value of the future cash flows, value in use. So the net realizable value is mentioned in answer B. So the answer B is the correct answer. I hope you understood about it. Are we clear? Right, great. Moving on. Any questions again? If you have any questions, doubts, clarify. Okay, moving on. Look at this one. So this is with regard to a new factory. So APLC has built a new factory incurring the following cost. So land, material, labor, architect's fee, surveyor's fee, site overheads, then apportioned administrative overheads, testing of fire alarm, business rates for the first year. So total amount is, numbers are given in thousands, 7,112. What will be the total amount capitalized in respect of this factory? Okay, tell me, very simple question. What is the standard in which this particular question is tested? Simple one. I'm sure all of you can answer. Hmm? What is the question? What is the standard? LK16, property, plant and equipment, right? So this is about the initial measurement of the property, plant and equipment. So the initial measurement of the property, plant and equipment should be at cost. Then cost comprise of three things. Number one, purchase price. Okay, so if I take a machinery, okay, before moving to this particular question, if I take a machinery which I import from a foreign supplier, let's say from Germany, so I have a purchase price. Then any cost directly attributable to bring the asset to the location and condition necessary for the intended use. Let's say from Germany to here, I had to bring the machinery, freight charges, insurance charges, custom duty, then transport charges from port to my warehouse. I had to incur a fixing cost. All these things are directly attributable cost to bring the asset into the current condition and location, which you can capitalize within the initial cost of the machinery. Third one is estimated cost of dismantling and removing the item and restoring the site on which it is located. So let's say this machinery is going to be used for 10 years. At the end of the 10 years, these are complex machinery. I have to remove the machinery. So then I have to clear the site. So for that, I need to incur a cost after 10 years, dismantling cost, removing cost, and clearing the site. So what I do is that particular cost to be incurred after 10 years, what I do is I have to calculate the present value of that cost, and that particular present value I have to include as a part of cost of the initial measurement of PP&E. You debit to the PP&E that particular present value and credit that to a provision account. Okay, are we clear? So this is how you these are the elements of the initial measurement of cost in the property, plant and equipment. Then before looking at the question again, I just need to tell you this particular point as well, especially about the directly attributable cost. Now, When it comes to the directly attributable cost, so what does that mean? These costs are incurred only because we purchase or only because we construct this particular asset, machinery or building or whatever, right? If not for the purchase, these costs are not going to be incurred, right? Directly attributable cost. You can't include the apportioned cost into the directly attributable cost of the property, plant and equipment. So you can't do any apportionment. So directly attributable cost mean if not for the purchase, these costs are not going to be incurred. And also you should understand what is the point at which you should start capitalizing the cost and what is the point at which you should stop capitalizing the cost. With regard to a PP&E item, you should start capitalizing the directly attributable cost only once you initiate a purchase transaction. So to give you an example, let's say, again, the same example, let's say buying a machinery from a German supplier. What I did was at the initial stage, I wanted to have a machinery where I was not aware who is the best supplier. What I did, I have arranged 5 of my team members for them to go there to Germany and inspect 5 different suppliers, and out of these 5 different suppliers, they need to select one. So for that particular visit, there are certain expenditure incurred, right? Yeah, their travel, then their accommodation, there's a cost. Then they came back, right? And out of these 5 suppliers, they based on the price, based on the capability, quality of the machinery, they selected one supplier. Now my question to you is the cost that they incurred for that initial visit to Germany, can we capitalize as a part of the cost of the machinery? What do you say? Can we capitalize that cost or not? No, you can't. Because why? You have not yet initiated the purchase transaction. So when do you initiate the purchase transaction? Now let's say these 5 people got together and they select a particular supplier based on the criteria of evaluation, and they decide, okay, I'm going to go ahead with this particular supplier, and for that particular supplier, in formal language, you raise a purchase order. You raise a purchase order. So the initiating the purchase transaction means you selected a particular supplier and you have communicated to him, okay, we have selected you. So normally raising a what PO? PO means what? Purchase order. Initiate the purchase transaction. From that particular point onwards, whatever the cost that you incur, you can capitalize. Is that clear? At the same time, what is the point at which you should stop capitalizing the cost? Once the asset is capable of being operated as intended by the management. So once the asset is ready, it is capable to operate as planned, as intended by the management, you should stop capitalizing. Because why I say that is sometimes you complete the asset, complete the particular machinery or building or whatever, but you do not actually start it. You wait for another 3 to 4 months. Okay. But what I'm telling is you should stop capitalizing the cost once the asset is capable of being operated as intended by the management. This can be a date which is earlier than the date where you actually use the particular asset. Are we clear? I hope you understood about it. Right. Now you have a good foundation to answer this question. Tell me now, what are the costs that you can capitalize in respect of this factory? So let's look at one by one. What do you say? Land, obviously, you can capitalize. Okay. Then material that we have used to construct the particular factory, you can again capitalize, right? These are, directly attributable cost. Then labor, so the people who have worked and their salaries to construct this particular factory. So in this case, it's a factory. You can capitalize. Then what about the architect fee? Now think about what I have mentioned over here. Is it a directly attributable cost? If it is directly attributable cost, if not for the purchase, this cost is not incurred. Now, obviously, if not this particular factory is constructed, this cost wouldn't have been incurred. So you incur this architect fee because you construct this factory, so that it is a what? Directly attributable cost. Same is applicable for the surveyor's fee. right? Same is applicable, because if not for the construction, you wouldn't have incurred this surveyor's fee. So you incurred that because of this construction, so you can capitalize. Site overheads, what do you say? Site overheads, a lot of people confuse here. There can be directly attributable overheads. Example, let's say for this particular project, you hired a supervisor, not an existing supervisor. You hired a supervisor for this project and his salary. Then whatever the consumables that you incurred, so on that you spent. So these are what specifically mentioned site overheads. So directly attributable site overheads you can capitalize. Then apportioned administrative overheads. What do you say? This is the point. Apportioned. That means your existing admin overheads, part of that is apportioned here. Can we capitalize that within the cost of the PP&E? No, because why? That is not a directly attributable cost. It's an apportionment only, right? Then testing of fire alarm. Yet again, normally you do the testing of the fire alarm before you confirm that it is capable of being operated as intended by the management, right? Without checking the fire alarm, you don't say that, okay, it is ready for use. It is capable of being operated as intended by the management. So that also a cost which you can capitalize. Then business rates for the first year. Now business rates, that is something which you incur during the year, right? So this is not something which you can capitalize. This is not a directly attributable cost for the factory construction. Okay, so which you can't capitalize, right? So once you add what is available, so what I have put a tick mark, 1200 plus 2400 plus 3000 plus 25 plus 15, then plus 300, then plus 10, that comes to 6,950. So this is in thousands. So that means 6,950,000. Correct answer is answer B. Are we clear? I hope you understood again. Right, let's move on. Okay, we discussed this. Right, question number 4. Read the question by your own first and tell me what is the area in which this is tested. This is a very simple one to tell that the area. Okay, tell me. What is it? What it says, APLC had the following bank loans outstanding during the whole of 2018. 9% loan payable in 2019, 15 million. 11% loan payable in 2022, 24 million. You have a couple of bank loans outstanding at different rates. APLC began construction of a qualifying asset on 1st April 2018 and withdrew funds 6 million rupees on that day to fund the construction. Then on 1st August 2018, additional 2 million was withdrawn for the same purpose. Calculate the borrowing cost, which can be capitalized in respect of the project for the year ended 31st December 2018. Right, so what is the borrowing cost that you can capitalize? So Shihani has identified the correct answer for the area. Obviously, LKS 23 borrowing cost standard. So as per this standard, whatever the borrowing cost that you incur for a qualifying asset, okay, that you can capitalize. Other borrowing cost you need to charge to the profit and loss statement. Qualifying asset means asset that necessarily takes substantial period of time to get ready for the intended use. Now here, when now you have actually a borrowing pool, right? You don't have a specific borrowing. Now for this particular construction, it is not specifically mentioned that this particular borrowing is used. So you have specific borrowings and you have general borrowings. Here what we have is a general borrowing because it was not mentioned the particular loan to a particular asset. So instead of that, it was mentioned that you have two loans. So when you have this type of a scenario, first of all, you need to calculate the capitalization rate. What is the weighted average borrowing rate that I have to use to capitalize the borrowing cost? Obviously, this particular construction, maybe a property, maybe a building, it is identified as a qualifying asset. So once you know the borrowing cost that you incur, you can capitalize. So as I mentioned, so the area of testing is LKS 23 borrowing cost. And what we do is we calculate this weighted average borrowing rate. You have two loans, 9% loan and 11% loan. Percentage is 9% here, 11% here. If you look at the values, now in the case of 9% loan, it is actually 15 million, 11% loan, 24 million. So altogether, how much? 39 million is the total. Then to calculate the weighted average borrowing rate, what we do is we multiply 15 million into 9%. That would give you the annual interest, annual finance cost. 15 million into 9%, which is, these figures are in millions, right? These figures are in millions, rupees million. So 1.35 million rupees, 1.35 million rupees. Then once you multiply by 24 million by 11%, the answer is how much? 2 million, 2.64 million, 2.64 million. Then you add the total finance cost, 1.35 plus 2.64, it would get an answer of how much? 3.99 million in rupees. Then what is the total borrowing value? 39 million. To calculate the weighted average borrowing rate, you take the finance cost 3.99 divide by 39. So you get the weighted average borrowing rate of 10.23%. I hope all of you understood how did you get that. Okay, hope it is clear. Then what you do is you need to now calculate the amount that you need to capitalize. If you look at the year end, it is important to understand the year end first. What is the year end? 31st December 2018. Year end is 31st December 2018. Right? Now, on this particular year end, so you need to calculate by the year end how many months it has been passed from, you know, investing this amount, borrowing out of this borrowing cost pool, out of this what you call borrowing pool, company withdraw certain amounts and invested in this asset. If you look at the first investment, 6 million was invested, withdrawn from the pool, borrowing pool, and invested on 1st April 2018. Now how many months from 1st April 2018 to 31st December 2018? You have 9 months period. So from this date onwards, 9 months. 6 million, 9 months, 6 million. Then on 1st August 2018 to 31st December 2018, you have how many months? 5 months, right? So that for 5 months period, you need to calculate the borrowing cost and capitalize that for amount into 2 million rupees, right? So very simple equation then. 6 million, right? That is the amount what you withdraw and invest in this asset on 1st April 2018. So the capitalization rate 6 million into 10.23% multiplied by 9 upon 12, because 9 months from 1st April to 31st of December, right? 1st April to 31st of December. Then for the remaining 2 million, which you invested on 1st August, again 2 million into weighted average rate 10.23% multiplied by how many months? 5 months, 1st August to 31st of December, 5 upon 12. So once you take the answers, 6 million into 10.23%, 9 upon 12, plus 2 million into 10.23% into 5 upon 12, the answer that you get is 545,600. So this is the answer. If you look at your answers, so the answer to the question is answer A. Are we clear? Simple question, right? This is a simple question yet again. Okay, right, moving on. Again, if you have any doubts, please put that in the chat box. Huh? Okay, look at this question. Question number 5. Read the question. machinery has a carrying amount of how much? 85,000 rupees at the year end. Machinery has a carrying amount of 85,000 rupees at the year end. What is the year end? 31st March 2019. Its market value is 78,000 rupees and cost of disposal are estimated to be 2,500 rupees. New machine would cost 150,000 rupees. Current cost. Okay. Company which owns the machine expects it to produce net cash flow of 30,000 rupees per annum for the next 3 years. So the future cash flows are for 3 years, 30,000 per annum. Cost of capital is 8%. What is the impairment loss? You have to calculate the impairment loss of the machine to be recognized in the financial statements as at 31st March 2019. Okay. What is the standard from which this question is tested? What's the standard? What is the standard? Simple one again. LKS 36, impairment of assets. Now we know that when you have an impairment indicator, it can be an internal indicator, it can be external indicator. When we find out there's an impairment indicator, you need to test the asset for the impairment, right? So it seems that with regard to this asset, there's an impairment indicator. I need to now perform the impairment testing. So the impairment testing sometimes referred to as impairment assessment, sometimes referred to as impairment review. It is the same thing. So when you perform this impairment review, you should understand what you really compare. You need to compare the carrying amount with the recoverable amount. Now, as per the question, you have been given the carrying value, right? Machine has a carrying amount of how much? 85,000. Carrying value is 85,000 rupees, right? Then in impairment, what we compare is carrying value with the recoverable value. What do you mean by recoverable value? When you have an asset, you have two ways to recover the value of the asset. One is you can continue to use the asset in the business and generate the future cash flows. There you get the what? Value in use. Present value of the future cash flows of the asset is value in use. That is one way to recover the value of the asset. The other way to recover the value of the asset is you can immediately sell the asset. If you immediately sell, what you can recover is the fair value less cost to sell. Fair value means again market value minus the selling cost, right? So now what is actually the recoverable value is out of these two values, fair value less cost to sell and value in use, whichever is higher. So these are occasion where the accounting standards allows you to take the higher of these two things, because normally it is the lower of, right? Why it is allowed to take the higher value out of these two is because when you have an asset, you have a choice. Either you can sell it or else you can continue to use that in the business and generate the future cash flows. So if you're a rational person, out of these two options, you go ahead with the what? Higher figure. So that's why the recoverable value is higher of these two items. Now in this question, you have been given information to calculate the fair value less cost to sell and value in use. It was mentioned market value is 78,000 rupees and the disposal cost is 2,500 rupees. So then fair value is 78,000, market value, selling cost to sell 2,500, which means what is the fair value less cost to sell? 75,500. 75,500 rupees, right? Okay. Then you have been given an unnecessary information to put you in trouble. What is that? New machine would cost 150,000. That's irrelevant here, not required here, right? Replacement cost, current cost is not required in the impairment assessment. What we need is the value in use. So for that, you have been given this particular machinery can be used for 3 years, and each year it generates a cash inflow of how much? Net cash inflow of 30,000. You have to calculate the present value of this future cash flow, right? So as it is the equal amount each year, you can use the annuity factor. Okay, you can use the annuity factor, or else you can prepare a present value table and calculate the present value, right? So one way is you can say year 1, 2, 3, what is the cash flow? Each year you get 30,000. Second year also you get 30,000. Third year also you get 30,000. Then you can calculate the discounting factor at 8% because cost of capital is 8%. Then get the present value at 8%, right? If you look at the discounting factor at 8%, so here I would say 0.926, right? 926. I hope all of you know how to get the discounting factors, right? So how to get the discounting factor? 1 divided by 1 plus r to the power n. R is the cost of capital. Discounting factor, n is the year. Now first one, 1 divided by 1.08 to the power 1. Second year, discounting factor 0.857. Third year 0.794. Okay, now you can take the present value at 8%. First one, 30,000 into 0.926, 27,780. Second year, 30,000 into 0.857, 25,710. Third year, 30,000 into 0.794, 23,820. Take the total. There can be small rounding out impact. 77,310. 77,310. Right? So then this is my value in use. Out of these two, which one is higher now? Fair value less cost to sell 75,500. Value in use 77,310. So recoverable value is higher of these two, 77,310. Because if I'm a rational person, I go ahead with this option. Rather than disposing the asset immediately, I will use the asset and generate the future cash flows. Now you see carrying value of the asset is higher than the recoverable value. In the financial statements, you can't keep an asset at a price or at a value which is higher than the recoverable amount, because even you have 85,000 in the balance sheet, what you can recover is only 77,310. You have to recognize an impairment loss for the difference, 85,000 minus 77,310. How much? 7,600. So the answer that I get here is 7,690. So what is closest? This one. Okay, rounding out impact, right? When we calculate this, what you call numbers, I have taken the figures into 3 decimals. So because of that, so the answer what I get is 7,690. So what is the answer given in this particular matter is 7,687. Okay, right. And one can even use the annuity factor, right? Because are we okay with that? Did you all understand this? Did you all understand this? I have to bring the asset value down to 77,310. So the double entry that I need to pass is in the impairment loss, P&L debit 7,690, whatever the asset account. Asset account credit 7,690. I have recognized the impairment loss. Hope all of you understood. Any questions? And as I mentioned, as the cash flows are same in each year, to calculate the present value, you can easily use the annuity factor. What is the annuity formula? 1 divided by, sorry, annuity formula. Okay, if you use this particular formula, you can get the annuity factor. Again, R is 8%, N is, now in this case for 3 years, N would be 3. Okay, 1 minus 1 plus r to the power n. You take the answer, divide the entire thing by using r. So you get the annuity factor. In this case, if I get the annuity factor for your information, how much? Annuity factor would be 2.577. This annuity factor into the annual cash flow, that is 30,000, I get the present value. How much? 77,310. So in both ways, I get the same answer, either by using the annuity factor or by using the discounting factors. So if you know the annuity factor, you have a shortcut. Why can I use the annuity factor? Because the cash inflow is same in each year. Okay, same amount. Right, okay, done. Moving to next question. So these are the questions that I'm taking from the mock exam paper, right? So rather than going through the paper, I put everything into a PowerPoint. Then it's easy. We don't need to shift the screen here and there. Then it's easy, right? Okay. What is the question number 6? Simple one. Which of the following is not mandatory step in IASB's due process of, very important word, not a mandatory step in the IASB's due process of setting the international financial reporting standards. IASB, International Accounting Standard Board, is the global body which actually prepares the financial reporting standards, IFRSs, right? So what we do here is we converged with the IFRSs and the IASs issued by IASB, okay, through the CA Sri Lanka. Okay, so now the question is, what is not a mandatory step that the IASB's process of setting up a international financial reporting standard? We know when IASB is putting up so the particular question is tested from the regulatory framework for financial reporting. Okay, regulatory framework for financial reporting. Under the regulatory framework, there are many areas. So out of that, so standard setting process of IASB. So this is the area from which this question is tested. So if you look at the process of developing IFRS standard, so IASB is doing a international consultation work. You get the views of different interested parties, individuals, organizations, for an example, auditors, accountants, CFOs, CEOs, right? So you get the comments. It's not something which is done by IASB isolatedly, right? So there's a due process followed. So in this particular due process, there are 4 main steps that we need to understand, right? Again, I'm not going to go through each of these steps in detail. In very brief, first of all, they do the agenda consultation. Agenda consultation means what they do is in every 5 years time, they do a review consultation and identify and finalize what is the project work plan for the next 5 years. Okay, which areas that we are going to look at. For an example, if I take examples, let's say sometimes back, they identified, okay, we need to look at financial instruments, we need to look at revenue, we need to look at leases. Okay, so that's why these standards, SLF, IFRS 9, IFRS 15, and IFRS 16 was released. So you identify what would be our work plan for the next 5 years. That is the agenda consultation. Then thereafter, you go to the research program. That means after finalizing the agenda, after finalizing the work plan, project work plan, you carry out some research activity. You explore the, now let's say you identify there are 3 areas that you need to focus, right? Then you do some research work on these areas, right? So thereafter you look at, okay, these are the now areas that we need to improve. Now under the agenda consultation phase, you actually identify, now I explained 3 things: financial instruments, with regard to the leases, and with regard to the what you call revenue. So there you identify these are the problems. These are the problems. This is why a new standard or an amendment is required for the financial instrument standard. That is done at the agenda consultation stage. That's why you identified these three items, right? Which we need to address in the next 5 years. So then under the research program stage, you do additional research work. You find out what are the problems in detail. You review the problems and you identify what are the possible solutions to these problems, right? So sometimes during the research program stage, you might issue a discussion paper as well, because what IASB does is IASB carry out the research work. IASB identify what are the possible problems. They identify what could be the solutions, and what they can do is, if they require, they can put up a discussion paper as well for the public to comment on what they have found out. At the end of the research program stage, they actually decide whether there's an amendment is required or whether there's a new standard is required. Sometimes in the research program stage, after doing the research work, after analyzing the what you call after analyzing the problem, they might decide, okay, not required to issue a new standard, not required to amend anything. So what is there is all right. On the other hand, if they find out, okay, there's a problem which you need to sort it out, the decision would be, okay, we need to make an amendment, right? We need to make this particular amendment. We need to issue a new standard. So for that, they might publish a discussion paper, right? Then finally, in the sorry, not finally, third step is to go for the standard setting program. Standard setting program. There, what you do is you actually now in the research program stage, you have done the research work, you review these research findings, and sometimes in the research program stage, you have published a discussion paper. You get the reviews of this particular discussion paper, and you draft the standard, new standard or the amended standard, and you publish that as a exposure draft first, not as a final standard. You publish that as a exposure draft. First of all, you publish that as an exposure draft, and thereafter, what happens is you the IASB and the other bodies relating to IASB is getting the global consultation. Even from CA Sri Lanka, they get their views, right, and put up the final standard. Okay, so that is the third stage, and the fourth stage is the maintenance program. Maintenance program means now the standard is released, and when people are implementing this particular standard, IASB wants to provide necessary guidances, implementation support. And if there are any issues at the time of the implementation, so IASB issue a IFRIC, additional interpretation. Additional help is provided under the maintenance program stage. So it's a long process. I wanted to, summarize what are the steps. So basically there are 4 steps: agenda consultation, research program, standard setting program, and the maintenance program. Now the question is, what is the question? Which of the following is not a mandatory step in the IASB's due process of setting the International Financial Reporting Standard? What do you say? They need to set the agenda. Definitely, they need to set the agenda. Then planning the project means actually they do the research. They drill down the problem. They find out what are the possible solutions. That is actually the planning of the project. So this is a step to be followed. This is a step to be followed. Then developing and publishing the discussion paper and developing and publishing an exposure draft. What do you say? That's why I said that it is very important to understand the question and read the question carefully. Actually, publishing a discussion paper is not a mandatory requirement. You can do that. You may do that. It's not a must. So you may publish a discussion paper at the end of the, so during the research program, you can publish, but it's not a mandatory step. But publishing exposure draft is a mandatory step that you need to follow in the standard setting program stage. So out of these 4, then This is also a mandatory step. What is not mandatory is actually answer C. Developing and publishing a discussion paper is not mandatory, but you should remember under the research program stage, when you are doing the research work, you may publish a discussion paper and get the comments of the uh, public, right? But it's not a must. But in the standard setting program stage, it's a must for you to publish a exposure draft before publishing the final version of the standard. Okay, I hope you understood, discussed in very brief about this process. You know, hope you understood about the answer. Right, that is the answer for the question number 6. Are we clear? Are we clear? Right, moving on. Right, look at this one. This is a very simple question. Can you answer to this question? Read the question and give your answer. Not a difficult one. Not a difficult one. Simply you can answer. What is it? Integrated reporting is sometimes referred to as triple bottom line reporting. What does this refer to? Okay, what does this refer to? So what is integrated reporting? So this is what is the area of which this particular question is tested? Obviously non-financial reporting, right? Important area. So in the non-financial reporting, you have different types of reporting like sustainability reporting, integrated reporting, triple bottom line reporting. Now, if you look at the integrated reporting, what it talks about is value creation. Not so there, what you focus is not the profit, but to create value by doing the business. It identified, not relevant to this question, but important for the examination, it identifies how many types of capitals? 6 types of capitals, right? So what are the 6 types of capital which is identified in the integrated reporting? I'll tell you an easy way to remember. Shin FM. What is that? Shin FM. What is that? First one, social and relationship capital. H, human capital. I, intellectual capital. N, natural capital. F, financial capital. M, manufactured capital. So 6 types of capital. It talks about the value creation. For an example, human capital. If I take one example, human capital. Training and development increase the human capital. Then if you exploit your employees, that would decrease your human capital, right? So then within this integrated reporting, so you explain how the different types of capital are transformed. Now, for an example, let's say you can earn short-term profit by exploiting your employees. But long-term, what will happen is you are hindering the value creation process of the organization, right? So that is about the integrated reporting. So you have 6 types of capital. Hope you know this area. So what is the question here is about the triple bottom line reporting. What are the 3 concepts? Triple means 3 concepts. What included under the triple bottom line reporting? So the triple bottom line reporting talks about economic aspects, environmental aspects, and the social aspects. So this is the sustainability. In sustainability means you consider the economic, environmental, and social impact, not only the economic aspect. So when it comes to the triple bottom line, so this economic aspect is called as profit. 3 P's: profit. Environmental aspect, planet. Social aspect, people. So what is the answer? Profit, planet, people. Answer D. There's nothing called power. Yeah, power. There's nothing called power in the triple bottom line reporting. So the answer to the question 7 is answer D. Okay, simple one. Question number 8. Question number 8. What is it? Which of the following is not a source of legislation relevant to Sri Lanka? Which of the following is not a source of legislation relevant to accountants in Sri Lanka? Now, you have been given 4 answers. Finance Act number 38 of 1971, Companies Act number 7 of 2007, Sri Lanka Standard Interpretation Act number 10 of 2001, Inland Revenue Act number 10 of 2002. Okay, yet again, the question is tested from Regulatory Framework for Financial Reporting. Okay, so before answering the question, these are the sources of legislation. Now, if you look at the regulatory framework, right? Regulatory framework, there are many different things. Number one, we have accounting standards. It's a mandatory requirement for the companies to prepare their financial statements as per the accounting standards. Then you have CSC, Colombo Stock Exchange listing rules, if you are a listed company. Then you have the other legislations. So under the other legislations, these are the legislations which are important and what is identified in your syllabus, right? Companies Act number 7 of 2007. As per that, all companies are required to prepare the financial statements as per the accounting standards. Plus, there are so many other provisions like solvency test, you know, under the distributions. There are a lot of provisions which are applicable for the preparation and presentation of financial statements. Then we have Sri Lanka Accounting and Auditing Standard Act number 15 of 1995. So this is the act which gives CS Sri Lanka the authority. This particular act mention that CS Sri Lanka is the sole authority to issue Sri Lanka accounting standards and the Sri Lanka auditing standards. And also this particular act identified special SBs, specified business entities. Okay, identified specified business entities. So the specified business entities are required to prepare their financial statements by using the uh, accounting standards which are published by CS Sri Lanka. Then Finance Act number 38 of 1971. This is actually important for the government organizations. When government organizations are preparing the financial statements, they need to adhere to the Finance Act. Then the Inland Revenue Act, so which discusses about the computation of taxes, which has an impact on the financial statements. Then the Employees Provident Fund, Securities and Exchange Commission Act. So these are the main legislations what is there in your syllabus. Now, if you know about these legislations, you can easily answer to the question. Which of the following is not a source of legislation relevant to accountants in Sri Lanka? What do you say? What is not in the list? Answer C. Sri Lanka Standards and Interpretation Act, number 10 of 2001. Okay. So that is something which is not applicable. Okay. And I don't think that there's an act like this as well. Okay. Right. Are we clear? Are we clear? Right. Any questions? Right. Okay. So there's a question to explain answer 7 once again. I will do that, but at the end of this, I'll discuss all the multiple choice questions and discuss it. It seems that you need bit of a detail. Let me take the detailed slides and explain the answer 7 once again, right? I will explain answer 7 once again. Seems that some of you have doubts. Okay. Uh, I'll explain that. Then number 9, which of the following situations does not suggest that leasing arrangement constitute a finance lease? Okay, which of the following situations does not suggest that leasing arrangement constitute a finance lease? Now, what is the area of testing? SLFRS 16 leases. So before moving to the answer, we know in a lease there are two parties, lessor and lessee. So lessor transfer or lessor provides the right of use the asset to the lessee. Now, as per the revised leasing standard SLFRS 16, lessee does not classify the leases into finance or operating lease. It's a lease. All the leases are recognized by the lessees in the books except for two exemptions. One is short-term leases. The other one is low-value items. Other than the short-term leases and the low-value items, lessee has recognized all the leases in the books of the lessee. You recognize the right of use the asset and you recognize the lease liability. On the other hand, accounting from the lessor's perspective requires leases to be classified into finance and the operating leases. If lessor transfer the risk and rewards with regard to the ownership of the asset to the lessee, it's a finance lease for the lessor. If the risk and rewards are retained by the lessor, it's a operating lease. So to decide a particular lease is a finance lease or an operating lease, in the standard you have been given 5 main criteria and 3 additional criteria. I'm not going to explain all the criteria, but if I highlight only the 5 main criteria to classify a lease by the lessor as a finance lease, if one or more of the things are satisfied, you can say that it's a finance lease, because you conclude that risk and rewards with regard to the ownership of the asset is transferred to the lessee. Now, what you okay, if one or more of the following apply, lease can most probably be considered as a finance lease. Number one, ownership passes to the lessee at the end of the lease term. Let's say I enter into a lease, it's a 5 years lease. At the end of the 5 year period, ownership of the particular asset transfer to the lessee, right? So then it's a what? Risk and rewards have been transferred to the lessee. It's a finance lease. Second one is option to purchase the asset at below fair value at the end of the lease, and it is reasonably certain that option will be exercised. So if I change my example earlier, it's a lease for 5 year period. At the end of the 5 year period, asset is not automatically transferred to the lessee, but lessee has a option. Lessee has a what? Option to purchase the asset at a price which is what? Less than the fair value, at a nominal value. As it is less than the fair value, it is reasonably certain that lessee will exercise the option. Yet again, what it says is it's a finance lease. But if the asset is transferred at market value, if there's an option to purchase the asset at the end of the lease term at market value, you can't say that it's a finance lease. Because why? Then you can't say that it is reasonably certain that the option will be exercised. Right? Okay. Then the lease term represent major part of the asset's economic life. Let's say asset's economic life is 10 years, lease term is, let's say, 9 years. So the lease term is a major part of the asset's economic life. So after 9 years, lessor get the asset, but lessee is the one who utilized the asset over a major part of the asset's economic life. Then present value of the minimum lease payments represent substantially all the fair value of the asset. If you look at the fair value of the asset, let's say fair value of the asset is rupees 10 million. When you calculate the present value of the minimum lease payments, that is amounting to rupees 9.8 million. Now, what does that mean? Lessee, through lease payments, pay the entire value of the asset to the lessor. Again, that is an indicator where the risk and rewards have been transferred to the lessee. It's a finance lease, right? The lease asset is specialized in nature so that only lessee can use it without major modification. The particular asset is so specialized, only lessee can use it, right? Now, let's say there's an asset which has an economic life of 25 years, but you enter into a lease period of 15 years. Even though at the end of the 15 years, if the asset is given back to the lessor, lessor can't do anything other than selling that under scrap, because that is so specialized, only lessee can use it. Then as the lessor, definitely you have to recover entire of your investment through that particular lessee. So in that case also, you consider the lease as a finance lease, because risk and rewards incidental to the ownership is transferred to the lessee. I'm going through fast. I don't have time to discuss all this stuff with examples and all that, because we have limited time. So these are the 5 main items that we need to look at when we classify a lease into a finance or operating lease. In addition to that, as mentioned, there are 3 additional criteria also to be looked at. But what is relevant for this question is only these 5 criteria, so that I limit my discussion at this point. Now you can answer to the question. Which of the following situation does not suggest that a lease arrangement constitute a finance lease? Very important, does not suggest. Part A. Answer A. Present value of the minimum lease payments is substantially less than the value of the asset. What do you say? Present value of the lease payments are substantially less than the value of the asset. Okay. To become a finance lease, if you look at the 4th point, present value of the lease payments should represent substantially value of the asset. Now, for an example here, let's say fair value of the asset is 10 million, but if you calculate the present value of the lease payments that is about, let's say 5 million. That is not a substantial amount of the value of the asset. So then it's not a finance lease, actually, it's a operating lease. Risk and rewards are retained by the lessor. This is not a finance lease. Let's look at the rest as well. Ownership of the asset transferred at the end of the lease term, finance. Lease term is for major part of the asset's economic life, finance. Lease contains a purchase option at a price below the fair value. There's a purchase option, it is below the fair value, which is reasonably certain to be exercised. Finance lease. So what is the answer? Answer A. That is not an indication of a finance lease. Yet again, I believe that you understood. Hope you are clear. Right. Okay. Question number 10. So this is the last question of the objective test questions. So question number 1 has 10 questions. Each question carries 2 marks. Look at this. CPLC is being sued by a customer for 2 million rupees for breach of contract over a cancelled order. There's an order which got cancelled. There's a breach. CPLC has obtained legal opinion that there is 20% chance that CPLC will lose the case. Only 20% chance is there for CPLC to lose the case. Accordingly, CPLC has provided 400,000 rupees. Why 400,000 rupees? 2 million is the amount that is claiming by the particular customer. So only 20% chance is there to lose the case. 2 million into 20%, 400,000. So CPLC has provided 400,000 in respect of this claim. Unrecoverable legal cost of defending the action are estimated to be another 100,000 rupees. These have been provided. These have been provided as the case will not will these have been provided as the case will not go to court until the next year. So the amount 100,000, what they did was they have provided this amount because that has not yet been incurred, because it seems that this particular case goes to the court next year. So what you did was you have made a provision for this 100,000. These have been provided. What is the amount of the provision that should be made by CPLC in accordance with LKS 37 provisions, contingent liabilities and contingent assets? How much is the provision that you need to make as per LKS 37? Obviously, the standard is LKS 37 provisions, contingent liabilities and contingent assets. What do you say? What is the answer? Can anyone tell me? A, B, C, or D? What do you say? Right. So just to give a heads up, for you to make a provision, 3 conditions to be satisfied. There should be a what? Present obligation. At the moment, there's obligation. This particular obligation can be a legal obligation or a constructive obligation. What is a legal obligation? Legal obligation means it is because of a legislation. It is because of a court order. It is because of a contract. You have obligation. So in this case, it's a court case. So that it's a what? Legal obligation. Right? Somebody has filed a court case against you. If you need to look at whether the conditions of provisions are satisfied, but what I say is these are kind of a legal obligation. Then constructive obligation means you create a valid expectation in the minds of some other party where you would discharge certain responsibilities. So pattern of past practice, published policies, sufficiently specific current statements would derive the constructive obligations, right? So as a result of a past event, and in this case, what is the past event? That particular customer has filed a case against you. There's a past event and it's a legal obligation, right? Then the second condition of making a provision is outflow of economic benefits are probable. What do you mean by probable? more likely than not. More than 50% chances there to happen this outflow. Now in this case, is it probable? CPLC has obtained legal opinion that there is only 20% chance that CPLC will lose the case. So can I say that it is probable? No, it is only possible, less than 50%. Then can you make a provision for the possible obligations? Answer is no. Right. Then the third condition is amount can be estimated reliably. Rupee value can be estimated reliably. If these three conditions are satisfied, you recognize the liability and make the necessary disclosures. You recognize the particular provision and make the certain disclosures. So this is actually guidelines in very brief. So what is defined in the standard is only this word probable, more likely than not, which means more than 50% chances there to happen the particular event. So this is the only thing which is defined in the standard. Others are industry guidelines. So there's a terminology called virtually certain, which means equal or more than 95%. Then possible means 50% or less. Remember, 50% is possible. 50% or less. Probable mean more than 50%. Then remote means equal or less than 5%. Now, if you look at the accounting treatment, this is a summary. So this identifies the prudence concept into account. If a liability is virtually certain or asset is virtually certain, you need to recognize. You have to recognize the liability, provide the liability, recognize the asset. If it is virtually certain. If it is probable, liability you provide provisions. But if an asset is probable, you don't provide, you just disclose. Okay. On the other hand, if a liability is possible, 20% in this case, it's a what? Disclosure. If an asset is possible, you don't disclose. Again, prudence. If it is remote, liability remote, asset remote, no disclosures. Now tell me, in this particular question, as you have only 20% chance to lose the case, you don't need to provide this 2 million. And even you don't need to do this 2 million into 20%. You take the 2 million multiplied by the probability, 400,000. You don't need to do that. You don't need to provide at all. It's a contingent liability. This 400,000, you just need to disclose this. But now there's a present obligation. What is the present obligation? Court case is filed. Then definitely to resolve this, you have to incur legal expenditure. You have to go through a lawyer. Now legal cost would definitely need to be incurred. How much is that? 100,000. As the case is filed, now you have a present obligation to incur this 100,000. So your provision should consist only of this particular unrecoverable legal cost of defending the particular case. For 2 million or 400,000, you don't need to provide. That is only possible. You just need to disclose. But for this 100,000, you need to provide. So what is the answer to the question? Answer D. What is the amount of the provision that should be made in the CPLC's financial statements as per LKS 37, provisions, contingent liabilities, and contingent assets? Is that clear with you? I hope you are clear with this. Right. Any questions? With that, actually, we answer all the questions or objective test questions in question number 1. Okay, in question number 1. Right. So I will explain about this, what you call question number 7. That is about this standard development, right? Okay. So I'll go into bit detail and explain, because it seems that when I just show these boxes, you might not able to get it 100%. I'll go into detail. So what we can do is we can have a short break. So as it took a lot of time, we'll have a short break. So after the break, as soon as after completing the break, I will explain you this particular process bit in detail for you all to understand. Okay. Any other questions? There's a question whether this recording would be uploaded. I think yes, Sri Lanka would upload the recording. Okay. Very important to get interactive and participate for the live session. No? Right. Okay. So what we can do is let's have a quick break. So 10 minutes, right? 10 minutes break. After 10 minutes break, we'll come back and discuss the other areas of the particular paper. Okay, right. Okay. Right. So had couple of questions during the break. So seems that you have questions from not from accounting stance, but this area of regulatory framework, non-financial reporting. Remember, so there are multiple choice questions from the from regulatory framework as well as non-financial reporting, right? So ensure that you know these topics as well. Similarly, accounting stance and the consolidation, right? So a couple of questions with regard to question number 6 and 7, right? So because of that, to explain these questions, I just need to go into detail. Now the question number 6 was, what is not a mandatory step? Now I told you, so when I was explaining, so this is from the regulatory framework. So 4 steps to be followed. It's a due process followed by IASB, getting involved with interested parties like auditors, accountants, CFOs. So they follow this process, and the process has 4 steps: agenda consultation, research program, standing setting program, and maintenance program. So as the question wants me to clarify a bit in detail, I have included 4 additional slides here, right? What it says under each stage, I'm not going to read through, right? I will share this presentation with Sri Lanka. So there you will get the presentation, right? So I'm not going to read letter by letter, word by word, right? So the agenda consultation means in every 5 years time, IASB, board means IASB always, here board means International Accounting Standard Board. They conduct a review, they consult various parties and identify what are the priorities, setting priorities, standard setting priorities, and develop a project work plan for next 5 years. What I'm going to focus, I'm focusing on revenue, I'm focusing on leases, I'm focusing on financial instruments. I'm taking examples, right? Okay, sometimes back it was the case actually. Okay, so setting up the priorities and identify these are the projects that I'm going to do, right? But in between, actually, now 5 years means long period. In between, depending on the requirement, they may add other stuff as well. But this is something that they follow in every 5 years time. Then when it comes to the second stage, in the research program stage, right? Now let's assume they identified these 3 areas. Out of that, if I select one area, financial instruments, they start with research. Now there's a particular matter that they have identified, financial instrument standard. A lot of parties requested to look at a new standard. Certain areas are not correctly represent the financial performance and position, need to be looked at. So what they do is, now the particular area, they do a lot of research. Start with research, the name itself, research program. Then explore the issue, go into detail and look at, and what are the possible solutions that can be brought in, right? And then after doing this research, right, they decide whether a standard, new standard is required or a amendment is required. So after doing the research, they decide. Now sometimes, so IASB make their decision, and board sometimes, here the word board means IASB may set out a discussion paper. May means not a must. Discussion paper and get the public comments as well. Now after doing that, they decide whether they want to go to the next stage or not. Sometimes at the research program stage, if they believe that no requirement is there to develop a new standard or amendment is not required, that's it, you don't go for the next stage. But the next stage, that is standard setting program, follow if you believe at the end of the research program there's a problem exists, sufficient evidences are there, sufficient evidence is there, there's a problem, right? Then it is important to amend the standard or to issue a new standard. By doing that, we can find a practical solution. So if they believe that there's a problem, we need to issue a new standard or we need to make an amendment, and through that we can find a practical solution for this problem. Then they go to the next stage. But here the point I wanted to highlight is, in the research program stage, publishing a discussion paper is not a must. It's an option that the IASB is having. Then if you go to the next stage, that is the standard setting program, here what board, again IASB, now ISB has made a decision in the research program stage, decided, okay, we are going to amend the standard or to issue a new standard. So to do that, you consider the reviews of the research stage. Now you have done a lot of research, you look at the summary, you review the research findings, and also if you have taken a if you have issued a discussion paper, you can look at the you can review the comments given by various parties, right? Then finally you decide, okay, this is how the new standard should be. You decide, okay, the standard has to be issued, so this is the standard, this is what we are going to do. And in this stage, what IASB does is they publish the what exposure draft. It's a mandatory requirement. Before publishing the standard, it's a mandatory requirement to publish a exposure draft. Then you get the consultation from global stakeholders, even from CS Sri Lanka, from various countries, various parties, global audit firms. They get the consultation. Based on the feedback and the proposals, they refined, and finally they put the amended standard or the new standard would be issued. So that would be done in the standard setting program stage. Finally, maintenance program mean now the standard is implemented. IASB is providing the support to implement the standard. If there are any issues, they try to resolve. And if there are additional interpretations to be issued, they get the help of IFRIC committee, that is International Financial Reporting Interpretation Committee's support to issue interpretations. And sometimes if the implementation is difficult, you can't implement, ISB might do some narrow scope amendments, right? And that is actually under the maintenance program stage. And also there you conduct the post implementation review to see that after a couple of years implementing and standard, whether the objective has been achieved. So this is in brief the process to be followed when developing IFRS standards. So this process is followed by IASB. I hope it's clear. Okay, right. So then answer to the question, what is not a mandatory step? Publishing a discussion paper is not a mandatory step, that is optional at the second stage, research program stage. I hope you are clear now, right? Okay. Then there's a question from question number 7 as well, this one. What is including the triple bottom line? This is very simple one, right? So integrated non-financial reporting, you have different types of non-financial reporting: sustainability reporting, integrated reporting, triple bottom line reporting. So this particular question is more specifically on what is included within the triple bottom line reporting. What I explained about this Shin FM was is actually in integrated reporting, you explain about 6 types of capital. So a lot of people finding it difficult to remember. So this is an easy way to remember that Shin FM. S means social and relationship capital, H means human capital, I intellectual capital, natural capital, financial capital, manufactured capital. So the question is actually from triple bottom line reporting. So what is included within the triple bottom line reporting? So that is 3 P's. Triple bottom line reporting, you can identify it as 3 P's. Profits would reflect the economic aspects, planet would reflect the environmental aspect, people would reflect the social aspect. So once these 3 are achieved, okay, once these 3 are integrated, we say that, okay, company is in the journey of sustainable development. So sustainability means not only the economic aspect, you also need to look at the environmental and the social aspect as well. So the triple bottom line reporting, because of that, includes profit, economic, planet, environment, people, society. Okay, so hope it is clear. So if you don't have any further questions, we can move to the question number 2 of the mock exam paper, right? Question number 2 of the mock exam paper. These things we discussed, right? Question number 2 is actually from LKS 41 agriculture. Okay, so specialized area. Some of you might not have the hands-on experience. So because of that, seems that bit complicated, but once you understand the concept, it's not. Now what we can do is, yet again, I have included the presentation, I have included the question into the PowerPoint, then you don't need to shift switch here and there. We can just focus on the presentation. Look at this question number 2. Now the advice what I can give you is, when you read the question, first of all, look at the requirement of the question. When you look at the requirement of the question, then when you read the question, you can plan the answer when you read the question itself. That would save your time, because one of the common issue that the students are having is not enough time. So one exam trick which I can tell you is, look at the requirement of the question before reading the question. What is the requirement here? Using the information above, you are required to advise delta with appropriate computations. You need to advise, okay, not just number crunching. Okay, you have to give your advice with appropriate computation. Compute and advise how Delta should report these transactions in the financial statement for the year ended 31st March 2022. You need to advise and compute, need to do the necessary computation and say that how these particular transactions are recorded in the financial statements for the year ended 31st March 2022. Right. By keeping that requirement in mind, let's read the question. Delta is a farming entity specializing in milk production. So they produce milk. Cows are milked on daily basis. So there are cows. Milk is kept in cold storage immediately after milking and sold to retail distributors on a weekly basis. Right? Milk is kept on a cold storage. On 1st April 2021, that is at the beginning of the financial year, Delta had herd of 500 cows which are all 3 years old. Same birthday, right? All of them are 3 years old. 500 cows. During the year, some of the cows became sick, and on 30th September 2021, that is at the middle of the year, 20 cows died. Okay, here. On 30th September 2021, 20 cows died. Right, 20 cows died. Then on 1st October 2021, that is next day, after these 20 cows died, Delta purchased 20 replacement cows, replacement cows at the market for 210,000 each. So you paid 210,000 for each cow. These 20 cows were 1 year old when they were purchased. Okay, so these 20 cows are 1 year old. And the purchase was happened on 1st October 2021, middle of the year. On 31st March 2022, Delta had 1,000 liters of milk in cold storage, which had not been sold to the retail distributors. Market price of milk at 31st March 2022 was 200 rupees per liter. When selling the milk to the distributors, Delta incurs when selling milk to the distributors, there's a selling cost of 10 rupees per liter. These amounts did not change during March 2022 and are not expected to change during April 2022 as well. Right. Information relating to fair value and cost to sell is given below. You have been given a table, fair value of a dairy cow on 1st April 2021, that is at the beginning of the year. 1st October 2021, the date new 20 cows were purchased, and 31st March 2022 at the end of the year. You have been given the fair value of 1 year old cows, 1.5 year old cows, 3 years old cows, and 4 years old cow. And cost to sell a particular cow in the market. Selling cost is also given on each specified date. So basically when you are now, okay, let me explain now what is the applicable standard here. As I mentioned earlier, What is the applicable standard? LKS 41 agriculture, right? So you should understand for which items LKS 41 is applied. So actually there are 3 items, right? But here for this question, what is important is only 2 items. I have included only these 2. LKS 41 applies for following items when they are related to an agricultural activity. What is an agricultural activity? There's a management happening. Now, if I take an example, let's say forest. There's no management, just trees are growing. It's not an agricultural activity. There's no management. But let's say if you grow trees to take timber, you manage these things. You manage these trees. Then it is an agricultural activity. Another example would be, hopefully most of you have visited Ambevala, okay, farm. So agricultural activity, right? So there are living animals and there's a management there. So if you have any biological assets, what is biological asset? Living animal or a plant, right? Biological asset. If there are any biological assets relating to an agricultural activity, LKS 41 covers that. Example, cows, sheep, right? Then plants, as I mentioned, trees which are grown to take timber out of these trees, as well as agricultural produce at the point of harvest. Now, if I take the example of a cow, cow is a living animal, biological asset. What do you mean by agricultural produce? Agricultural produce mean harvested product of this biological asset. What is the harvested product of the cow? Milk. So LKS 41 is applicable for this agricultural produce, milk, importantly at the point of harvest. Very important. Not after the point of the harvest, at the point of the harvest. After the point of the harvest, actually LKS 41 is not going to be applied. There's a separate standard. Then after the point of harvest, this milk, what you store, would become inventory. Then what is applicable? LKS 2. Right? Okay. So let me explain this in this way. Think about this example. It seems someone's mic is switched on. Please mute your mics. Right? You accidentally forget about it. So please mute your mics. Okay. Right. So farmer buys a dairy calf. Who is calf, by the way? Small fellow of the cow, right? Small cow is called as calf. So farmer buys a dairy calf. Now, what is calf? Calf is a what? Biological asset, living animal. Then this cow, then this calf, small cow, grows into a mature cow. What is this process? There's another name for this process. This is actually biological transformation. So the biological transformation can comprise growth, calf grow into a cow, or else biological transformation can include actually growth, production. Cow can produce milk, procreation. Cow can give the birth to another calf. That is also biological transformation. Then degeneration, biological asset. That means cow is old and become unproductive. So so biological transformation mean it can be a growth, it can be a production, it can be a procreation, it can be a degeneration that cause a qualitative or quantitative change in the entity's biological asset. Now this calf growing into a cow is a biological transformation, right? Then what you do is farmer milks the cow. Now the milk that you take, milk has been harvested, milk is the growth, is the biological transformation, milk is the agricultural produce. Now, in this particular example, LKS 41 is applicable for the biological asset, calf to cow. It can be a calf, it can be a cow, living animal, as well as agricultural produce, harvesting of milk. Very important at the point of harvest, not after the point of the harvest. After the point of the harvest, same agricultural produce would become inventory. Then the applicable standard, as I mentioned earlier, LKS 2. I hope you got a idea about that now. Okay, right. Then before moving to the question, let me explain about this particular concept as well before moving to the answer. Measurement. So biological assets are measured at initially as well as at the end of each reporting period. Initial measurement as well as the subsequent measurement is at fair value less cost to sell. So this is another place where the concept of fair value comes into play. How to measure the fair value? As I mentioned earlier, it is discussed in a separate standard, SLFRS 13. It defines fair value. It discusses about how to calculate the fair value. So the definition of fair value is price at which asset could be sold or a liability can be transferred in a arm's length transaction between the market participants. Okay, so what is the price at which, if you have an asset, what is the price at which that particular asset can be sold? If you have a liability, what is the price that you need to pay to transfer that liability? And this transaction should happen across the among the market participants. That means sellers and buyers, so they don't have any relationship, and at a particular measurement date. So this particular measurement date can be the initial measurement date or subsequent measurement date. So if you look at the biological assets, biological assets are initially as well as subsequently measured at fair value less cost to sell. Now, sometimes, sometimes the questions doesn't explain about the selling cost. If you don't have the selling cost, if you have not been given information about the selling cost, then you can ignore that and you just need to measure the biological asset at fair value. But in this particular question, in the question, it specifically mentioned this is the selling cost. When you are given the selling cost, your measurement should be initially as well as subsequently fair value less cost to sell. Then the changes in the fair value less cost to sell, you need to take to the profit and loss statement. So initial recognition of biological assets as well as subsequent measurement of the biological assets would result gains and the losses to be recognized in the profit and loss statement. Unrealized gains and the losses are to be recognized in the profit and loss statement. Okay. Sometimes these biological assets, you can't measure the fair value reliably. Now, if I take an example of a plant, let's say you want to have some trees, you want to grow trees to take timber. So you start with small plants, you buy the small plants. These are called as nursery plants. Sometimes when they are at the nursery stage, you can't measure the fair value reliably. So then up until the point where you can measure the fair value reliably, you measure the particular biological asset at costless depreciation minus impairment. As soon as you can measure the correct fair value, then you change the measurement basis to fair value less cost to sell. But if you can measure the fair value less cost to sell, there's no issue. So this particular matter comes. If you can't reliably determine the fair value, then you follow the costless depreciation minus impairment as soon as where you can measure the fair value, you shift to the fair value less cost to sell measurement. That is about the biological assets. Then with regard to the agricultural produce, now think about the milk. Now let's say you milk the cow. You get, let's say, 100 liters of milk from the cow. How are you going to account for that? How are you going to account for that? You identify the agricultural produce. So as per this standard, LKS 41 is applicable for the agricultural produce at the point of harvest. At the point of harvest, you need to measure this agricultural produce at fair value less cost to sell. So if it is 100 liters multiplied by the fair value less cost to sell, you get the value. You debit that to the agricultural produce, and where to credit? Debit agricultural produce, where to credit? Credit profit and loss. You can't credit cow, right? Okay, you have to credit that to the profit and loss statement. You need to recognize a profit immediately when you recognize the agricultural produce. Okay, so then this agricultural produce would become the inventory. After the point of harvest, LKS 41 is not going to be applied. Then what is going to be applied is LKS 2. So in this particular fair value less cost to sell would become the cost, deemed cost for the inventory valuation purpose. Whatever the fair value less cost to sell that you have recognized as the agricultural produce, you transfer to the inventory. So it would become inventory, and the inventory has to be initially measured at cost. Cost equals to the fair value less cost to sell at the point of harvest of the agricultural produce. So this is the cost for the inventory valuation purposes subsequently. Right. So I explained about this gains and the losses in terms of the biological assets, initial recognition as well as subsequent measurement amounting to fair value gains and the losses. Those are recognized in the P&L. In the case of the agricultural produce also, at the time of initial recognition, when you take the milk out of the cow, you recognize that and the gain is taken to the profit and loss statement in the period in which it arises. Now we have a solid foundation to answer to the question, right? So our question was this. So I actually explained you the bit of a theory to answer to the question. Now what we need to do is we need to understand, apply this theory to the particular scenario. Any questions up to now? Do you have any questions up to now? Nothing. Understood everything. Okay. Right. Now tell me. Ultimately, the question wants us to show the transaction in the financial statements. Tell me with regard to this transaction. Now we need to answer, right? What would appear in the statement of financial position of this company with regard to these transactions? What it would appear in the financial statements of the company? If I take the statement of financial position, what do you have? You have cows, biological asset. Okay, that has to be recognized. So biological asset is actually a non-current asset. On the other hand, at the end of the year, last para says you have 1,000 liters of milk. That is what? That would become initially the agricultural produce and thereafter the inventory. So inventory is a current asset. These two are to be there in the statement of financial position. Are we clear? Statement of profit or loss, you would have fair value gains and the losses of the initial measurement and the subsequent measurement. And in addition to that, in this question, there's additional complications because 20 cows were died. So when the cows are died, so they are the like carrying value of these 20 cows, you need to charge to the profit and loss statement. So that is what we need to do in this question. Now let's look at the answer. Carefully look at this answer. Okay, focus on this. You don't need to write anything to save time. What I did was all the calculations also I have included into the presentation. Then we can discuss the things in detail. Uh, you know, so that's why I put that into the presentation. Biological asset. Ultimately, I need to know that what is the biological asset value as at 31st March 2022. So this is a non-current asset in my statement of financial position. What is the opening value? So if you look at the question, it's clearly mentioned 1st April 2021, how many cows were there? You had herd of 500 cows. When you measure the biological assets, you don't need to measure the fair value less cost to sell of each cow. You don't need to do that. You can take them as a category, look at the similar characteristics. In this case, based on the age, you can say that all these 500 cows are 3 years old, so that if I know the fair value less cost to sell of a 3 years old cow, I can take that value and multiply it by 500, where I get the fair value less cost to sell of entire herd of 500 cows. Right. Now, as per the question, 1st April 2021, this is what I need because all these 500 cows are 3 years old. 3 years old, 1st April 2021. What is the fair value? What is the fair value? 270,000. Remember, the measurement is not at fair value less cost to sell. On 1st April 2021, to sell a particular cow in the market, there's a selling cost of 10,000. Then tell me what is the fair value less cost to sell of a 3 years old cow on 1st April 2021? What do you say? What is the fair value less cost to sell of a 3 years old cow on 1st April 2021? 270,000 minus 10,000, it is 260,000. So you have how many cows? 500 cows. Then I can say that this is the brought forward value 500 cows, fair value less cost to sell 270,000 minus 10,000, 260,000. What is the value? 130 million. 130 million. Is that clear? Right. Then as per the question, 20 cows were died, right? Here, 30th September 2021, out of these 500 cows, 20 cows died. Now, what do? You have to derecognize. Out of these 500, 20 you need to derecognize. So, what is the value that we have kept for 500 cows on 1st April 2021? 130 million. So then you can take the proportionate value of these 20 cows. Or else, because one cow was valued at, now if I go to the answer over here, one cow was valued at 260,000. So you take 20 cows, 260,000. How much is the answer? 5.2 million, right? Or else what you can do is 130 million is for 500 cows. Out of that, so this also can be derived in this way. Now 130 million is for how many cows? 500 cows. If so, what is the value of 20 cows? 5.2 million. 5.2 million. What's the double entry of that? You have to derecognize. You credit the particular biological asset, minus means credit, and you debit that to the P&L. If you look at the profit and loss for the year ended 31st March 2022, so this amount relating to 5.2 million, that has to be charged to the P&L. It's a loss, right? Debit P&L 5.2 million, credit the biological asset 5.2 million. Are we clear? The double entry. Okay, double entry here. Debit P&L 5.2 million, credit the biological asset 5.2 million. Is that clear? Right. Then on the same date, or else actually on the next day, I would say that is on the next day rather than 30th. I can make the amendment 1st October, right? So 1st October 2021, company purchased 20 cows. Go back yet again here. 1st October 2021, Delta purchased 20 replacement cows to replace these 20 cows died. What is the price at which that they bought these 20 cows? One cow 210,000, and these 20 cows are 1 year old. 1 year old, right? When they were purchased. That means you have the initial recognition of a biological asset. Now, how to measure the biological asset at the initial recognition? Yet again, fair value less cost to sell. What is the fair value? 210,000, the purchase price. But it has to be measured not at fair value. Remember, fair value less cost to sell. Now, if you look at here, 1st October 2021, what is the fair value of 1 year old cow? 210,000. That is the purchase price. But the measurement should be not at fair value, but at fair value less cost to sell. What is the selling cost? 10,000. Yet again, fair value is 210,000. Fair value less cost to sell is 210,000 minus 10,000. It has to be 200,000. So I need to add to the biological asset 200,000 per cow into 20 cows. Right? Even though I have paid 210,000 per each cow, right? I need to add to the biological asset only fair value less cost to sell 200,000. 200,000 rupees into 20 cows, which is how much? 4 million. Okay, can anybody tell me what is the double entry that I need to pass here? Now, obviously, if I write the double entry over here at the top for this particular transaction, which has happened on 1st October 2021, right? There's a transaction happened. So in this transaction, So you debit the biological asset. You debit the biological asset. How much? 4 million. But how much you have actually paid in cash? That is fair value less cost to sell. How much you have paid in cash? You actually paid how much? So how many cows? 20 cows. Per cow you paid 210,000, right? As per the question. So 210,000 into 20 cows. You paid 4.2 million. Now the credit cash 4.2 million, debit the biological asset 4 million. Now can you pass an entry like that? No. Debit, there's a difference of how much? 200,000. Where should I charge this 200,000? Profit or loss. You see, at the time of initial recognition of the biological asset, amount of the cash paid is more than the fair value less cost to sell. So in other words, this 200,000 is the cost to sell, right? Because for each cow, 10,000 selling cost. 20 cows, 20 cows, selling cost is how much? 10,000. How much is the answer? 200,000. So the selling cost is immediately charged to the profit and loss at the initial recognition of the biological asset when you purchase the biological assets. So 4 million is, as I mentioned over here, is added to the biological asset. This 200,000, if you look at, it has been charged to the P&L, cost to sell of these additions. 20 cows, 10,000 rupees each. 200,000 you charge to the P&L. I hope it's clear. So this is something which students are not getting correct. I hope now it's clear for you. Okay, right. Then at the end, now tell me how many cows that you have at the end of the financial year, 31st March 2022. How many cows are there? At the beginning of the year, you had 500 cows. Out of that, 20 cows died. So these 500 cows were 3 years old. And out of that, 20 cows died. So that means out of these 500 cows, only 480 cows would be remained at the year end. So now they are how many years old? They are 4 years old. All of them are now what? 4 years old, right? At the beginning of the year, 3 years, now 4 years. Then you purchased 1 year old 20 cows on 1st October 2021. Actually, these 20 cows are there at the year end and they are 1.5 years old now. 1.5 years old. What you do is you have to calculate the fair value of 480 cows who are 4 years old and 20 cows who are 1.5 years old. You can't put these two together and say that 500 because the age is different, characteristics are different. So the fair value less cost to sell or the fair value of 4 years old cow and 1.5 years old cow is different. So for that, I need the, now what you do is you need to keep a space to get the balancing figure because you have to keep a space here. This would be my balancing figure. What is the year end number? 480 cows. Now, if you look at 480 cows, 4 years old, 4 years old, 31st March 2022. What is the fair value? 265,000. That is the fair value. Selling cost 11,000. 265,000 minus 11,000. That would be 254,000. So 480 cows into 254,000. Fair value less cost to sell. Then I have, so I have of this, I have 480 cows, 480 cows. Then at the year end, I have 20 cows, 1.5 years old. What is the fair value? 235,000. Again, the selling cost is 11,000. Then the fair value less cost to sell 224,000. So I have 20 cows. So 480 into 254,000 rupees plus 20 into 224,000 rupees. That would give me the year end value of my biological asset. 480 cows, value less cost to sell 254,000 plus 20 cows, 1.5 years old, value less cost to sell 224,000. So what is the answer? 126 million 400,000. 126 million 400,000. Then what is my balancing figure? This is my balancing figure in the schedule. It's a negative 2.4 million. It's a decrease of the biological asset by 2.4 million. You credit the biological asset, double entries credit the biological asset, and debit charge to the profit and loss. So because it is measured at fair value less cost to sell, and the fair value less cost to sell changes, unrealized changes in the fair value less cost to sell, you take to the P&L. So there's another charge to the P&L. So ultimately at the year end, you have a biological asset which is to be shown as a non-current asset in my statement of financial position, which has a value of 126 million 400,000. Then my total P&L charge in terms of this particular biological asset is 7.8 million. This is charged to the P&L. Are we clear? Any questions up to now? Still, we have not yet completed the question. Up to now, do you understand? Do you have any questions? Did you understand at least? Give the answer, give the feedback. Do you understand? So, are you getting the things what I say? Otherwise, I'm just speaking and you are listening. No interaction. So, did you understand what I say? Clear? Explanations are clear? Right. Okay. So then, uh, not only this, we have one more thing. Uh, Sorry, we have one more thing. What is it? Milk. Now we discussed about the cows, but if you look at the year end, 31st March, 31st March 2022, 31st March 2022, Delta had actually 1,000 liters of milk in cold storage. That is not yet sold to the distributors. Market price of milk at 31st March 2022, 200 rupees per liter. And what is the selling cost per liter? 10 rupees per liter. Now, what is this? Milk is the harvested product of entity's biological asset, which means milk is the agricultural produce. LKS 41 is applicable at the time of harvesting, right? At the time of harvesting, so this milk has to be measured at fair value less cost of sale. Now, at the year end, how many liters are there at the warehouse in cold storage? 1,000 liters. What is the fair value per liter? 200 rupees. Selling cost is 10. That means fair value less cost of sale would become 190. 200 minus 10 per liter. Then with regard to these 1,000 liters, you have to initially recognize this as an agricultural produce at the time of harvest. 1,000 liters into 190 rupees per liter, which comes to now if you look at the answer here, milk held by Delta at the year end will be regarded as harvested produce under the principles of LKS 41. So it has to be measured at fair value less cost to sell, 190 rupees per liter into 1,000 liters, 190,000 rupees. Then this particular agricultural produce after the point of the harvest would become inventory. This 190,000 rupees fair value less cost to sell would become the initial cost for the inventory valuation. So now this particular milk you are keeping for trading to sell, or else you might keep this milk to further process. Then it would become inventory. So 190,000 would become the deemed cost for the inventory valuation initially. After that, you have to apply LKS2 inventory standard. So the inventory has to be measured cost or NRV, whichever is lower. Cost is how much? 190,000. Value less cost to sell would become the deemed cost of the inventory, 190,000. Then at the year end, what is the net realizable value? So as per the question, it was clearly mentioned the selling price has not been changed during the month of March as well as in April. So which means the net realizable value is not less than the cost. So the inventory can be kept at cost amount into 190,000 rupees. So if I read it, uh, milk held by Delta at the year end will be regarded as the harvested produce under the principle of LKS 41. Harvested produce is recognized in inventory at an initial carrying amount of fair value less cost to sell at the point of harvesting. In this case, initial recognized amount would be 190,000 rupees. That is 1000 liters. Fair value less cost to sell per liter is 190. So this is initially recognized as the agricultural produce, and thereafter this will be the cost of the inventory, which will henceforth be accounted under LKS2 inventory standard, right? So then inventory has to be measured cost to NRV, whichever is lower. So you have been given an indication here. These amounts, if you look at this, these amounts did not change during March 2022 and not expected to change during April 2022. That means this fair value remain constant. Now, because after you account this milk as inventory, let's say the selling price has come down. If the selling price has come down per liter, your net realizable value can be less than the cost. Then you have to do an inventory write-off. But here it's clearly mentioned there are no changes in the market price of the milk even in April. Okay, because you are selling this milk to the distributors on weekly basis. That means maybe in the first week of April you are selling this stored milk in the cold storage to the distributors. So the net realizable value is not less than the cost. So the inventory can be measured at 190,000 rupees. Inventory of milk will be shown as a current asset. So inventory is a current asset on the balance sheet. In the statement of financial position of Delta, market price of milk is not expected to decline in the near future, so that there is no need to write down to net realizable value. So you have one non-current asset, that is what biological asset, 126.4 million. You have one current asset. What is the current asset? Inventory. Current asset is the inventory. Value is 190,000 rupees. On the other hand, so there's a P&L charge in total 7.8 million in terms of the biological asset. Not only that, if you look at the P&L now throughout the year, you would have harvested milk, right? That is your business. Throughout the year, you would have harvested milk. At the point of harvest, every time you need to fair value less cost to sell the particular milk that you harvest. You debit that to the agricultural produce. The credit entry goes to the P&L. That means there can be a huge amount of profits that you have recognized through harvesting milk during the year, right? That figure was not given. I have not been given how many liters of milk have been harvested throughout the year. So the entire amount would become agricultural produce at the point of harvest. You measure that at fair value less cost to sell. Double entry goes debit agricultural produce, credit P&L. So that amount recognized under that, so harvesting of milk in the P&L is not given in this particular question. Information is not provided in this question to calculate the amount that you recognized in the P&L by harvesting milk from the cow. Right, we have done the computations and we have provided the advice as well. I hope you understood about it. Okay, so where are these now 7.8 million? We are going to charge. That's a management decision, right? Standard doesn't specifically mention that, okay, if a cow is died, 5.2 million to charge here to the P&L, 200,000 under this heading. No, it says it has to be charged to the P&L. Management has to decide. So based on the faithful representation, where you should charge this 7.8 million in the P&L. So this is actually their main business. If it is main business, you need to charge to the cost of sales. Right. Okay, any questions? Any
What is the
questions?
double?
Yeah.
Hello. So what is the double entry for the to transfer the agriculture produce to inventory?
Credit agricultural produce, debit inventory, same amount, 190,000 rupees. Initially, it would become agricultural produce, right, worth of 190,000 rupees if I take the numbers from this question, right? So you debit agricultural produce 190,000, credit P&L, right? Then the same 190,000, you credit the agricultural produce and debit inventory. At the time of transfer, there's no profit or loss is recognized because fair value less cost to sell would become the deemed cost for the inventory valuation initially. Hope it's clear.
But the cows are recognized as per LK 16, right?
No, no. Cows are recognized as a biological asset under LKS 41. Okay, so I think need to elaborate that particular question. I didn't go that. Okay,
Since they
let me explain that.
produce, since they
Yeah,
produce harvest, yeah.
let me explain
So,
that. So not applicable for this question, but let me, as he asked the question, let me explain that. When it comes to the biological assets, right? You have two types of biological assets: bearer biological assets and the consumer biological assets. So if I take a tree, now let's say certain trees, if I take an example, if you grow trees to take timber out of the tree, what you consume is the tree itself, then it would become a consumable biological asset, right? So the even the tree is measured under LKS 41. You measure the tree at fairly less cost to sell, but you can grow a tree. Now let's say if you take an example of a fruit tree or a grapevine, that particular tree is used to produce agricultural produce for more than one time. Right, now let's say if you look at a mango tree, that particular mango tree would give you mango in each season, right? That particular tree is called as a bearer plant, bearer biological asset. If it is a bearer biological asset, then the standard applicable for the mango tree is LK 16, property plant and equipment, right? So if I take the example, bearer, BA means biological assets, huh? Consumable biological assets, right? So this particular matter is applicable specifically with regard to the plants, bearer plant and consumer plant. Now, as I mentioned, so the example here is fruit tree. Okay, so here the example, tree grow to take timber, right? Tree grows to take timber. Now, the particular fruit tree is considered as a property plant and equipment. This is a PP&E coming under LKS 16. Either you need to apply the cost model or the revaluation model. But unharvested fruit, unharvested mango on the mango tree is considered as a biological asset. It's an agricultural produce of a biological asset. So the tree is accounted under LKS 16, but the unharvested mango is accounted under LKS 41. But if you look at this one, consumable biological asset, that is the tree that you grow to take timber out of the tree, where what you do is you consume the tree itself. So the particular tree, let's say a teak tree or a mahogany tree, that particular tree is a biological asset that, so you apply LKS 41 to account the particular tree. Okay, so bearer plant and the consumable plant, you apply different treatments. But with regard to the animals, now this particular example is with regard to the animals. With regard to animal, you apply LKS 41 to the animals. I hope you are clear.
thanks, sir. Clear.
Okay. And also I have not confused the others, I believe, right? So always, that's why I mentioned here, you have biological assets include living, animal or plants. When it comes to animals, LKS 41, right? When it comes to plants, You can have bearer plants or you can have consumable plants. When it comes to bearer plant means it produces agricultural products more than 1 year. So the particular bearer plant is covered under, accounted under LKS 16, property, plant and equipment, cost model or the revaluation model. But the consumer biological asset, which means you consume the particular asset itself, particular plant itself. Tree grows to take timber. So for that, what is applicable is LKS 41. The tree is measured under LKS 41. So you have to measure the tree at fair value less cost to sell. Okay, right.
So one more question.
Yeah,
So this 20 calves purchased at 224,000. How this 224,000 arised
20 cows. Okay, let me see.
at the end of the period?
This one, right? Delta, you're asking about this particular matter, right? Delta purchased 20
Yes,
replacement cows at market price of 210,000. Am I correct?
yes, sir.
All right. Okay, so how much you have paid in cash? Now let's forget about this particular stand or anything. You need to buy 20 cows and you pay 210,000 per cow. How much you have paid in cash? How much of cash goes out from your pocket? 4.2 million. Am I correct? Yeah, 4.2 million. You paid 4.2 million here. Credit cash 4.2 million. Correct? No? But the standard says that once it becomes a biological asset, the initial measurement of the biological asset has to be fair value less cost to sell. Now, if you look at the selling cost on 1st October 2021 to sell one cow, it would cost you how much? 10,000 rupees, right? Now, fair value is the purchase price 210,000. Okay,
Okay.
fair value is 210,000. There's selling cost of 10,000. So, what is the fair value less cost to sell? 210,000 minus 10,000, 200,000. Am I correct?
Correct.
Right. 200,000 into 20 is the biological asset. So this 400,000, sorry, 4 million means 200,000 is the fair value less cost to sell, rupees 200,000 into 20 cows, 4 million,
Okay.
right? So the difference between the 4 million and 4.2 million, where do you charge to the P&L? So the point that you to understand is when you measure the biological assets initially at fair value less cost to sell, on day one itself, there's a charge to the P&L. What is the charge to the P&L? Selling cost.
Selling cost.
So 200,000 is the 20 cows. Each cow selling cost is 10,000. So 200,000 you charge to the profit and loss statement.
Okay,
I
sir.
hope you're clear. Got it?
Yes, sir. One more thing, sir. This 224,000 as at 31st March 2022 for these 20 calves.
Didn't
200,
get it.
224,000 for 20 calves at the end of the period.
Okay, this figure, this particular figure.
Yes, sir, exactly.
Okay, how did I get that? No, right. Okay, now at the end of the year, I have how many cows altogether? I have 480 cows from the actually 4 years old because I had 500 1 year ago, 20 died. So they were 3 years old at the beginning of the year. When it comes to the end of the year, they are now 4 years old, right? I have 480 cows,
Yes,
4 years old.
yes,
Then I have purchased 20 cows, right? I have purchased 20 cows on 1st October 2021,
yes,
right? At the time of purchase, they were 1 year old,
yes,
right? At the end of the year, they are now 1.5 years old.
yes, sir.
Okay, I have 480 cows, 4 years old. I have 20 cows, 1.5 years old, right? If I go to the table, what is the fair value less cost to sell of a 4 years old cow here? 31st March 2022, 4 years old, fair value 265,000, selling cost how much? 11,000. Fair value minus the selling cost, 265,000 minus 11,000, 254,000. Got it?
Good, sir.
Right. Similarly, 20 cows, fair value 1.5 years old, 235,000, selling cost 11,000, 235,000 minus 11,000, 224,000.
Okay,
Got it?
sir. Now go clear.
Right, excellent.
So I have small doubt.
Yes.
So to recognize as a biological asset, normally the cost should be reliably measured. And the second thing is future economic benefit should flow. So when new halves are born, like how do we take, because they are not to the level where we can take milk. So can we take it to biological asset or
It's like this.
others?
Now, yes, so the measurement as per the standard it has to be fair value less cost of sale. But if you can't measure the fair value reliably, you are allowed to take that at cost. Now, if a new calf is, like birth at that time, sometimes there's no cost even, right? So up until the point where you can reliably measure the fair value, so it is not recognized. You could raise it. As per the standard, it has to be measured at fair value less cost of sale. But as you correctly mentioned, there can be a situation, especially in terms of the animals, you don't know the fair value, and even there's no cost at that time. Up until you can measure the fair value, you can't recognize it. As soon as if you can measure the fair value, at that time you need to recognize. But in the case of calf, there's a possibility, after some time you can measure the fair value. I hope I answered to the question, right? There are practical issues. That's why I said that at the very beginning, this is a specialized sector. Some of you might not have, most of you actually might not have the practical experience. A lot of developments are also happening, right? For an example, the question asks consumable biological asset, where are biological assets, right? So a lot of developments are also happening around this particular area, right? Okay, revisions are happening. So this is what I mentioned. If you can't reliably measure the valueless cost of sale, measure that at costless depreciation minus impairment up until you can reliably measure the fair value. But there can be a situation you can't measure you don't have a cost. So there you have to wait until you can measure the fair value reliably. Hope I clarified the doubt.
Thanks, sir.
Right, great. Okay, we are done with that question. Right, next question number 3. So what we should do, shall we have 5 minutes break before starting?
Also, I have some doubts, sir.
Yeah.
Why don't we, while that means the milk we are converting, no, the price per liter is 200 and the fair value is 10 rupees. So why don't we charge that 10 rupees, the aggregated amount to the PNL?
That you don't incur, right? Now let's say the difference between the purchasing of 20 cows and the producing of milk is, when you purchase 20 cows, you pay, right? There's a cash outflow. Am I correct? But when cow produce milk, there's no such cash outflow, isn't it? Do you get my point?
Yeah, I understood.
So actually, when you measure that at 190, now when you measure it at 190, the double entry that you pass is 190,000 debit agricultural produce, credit to the PNL. Actually, that 10 is already charged to the PNL. Otherwise, it would have been 200,000 credit to the PNL, isn't it? If
Yes,
this
sir.
selling cost is not there, it would have been 200,000 credit to the PNL. Why it is 190,000 credit to the PNL? 10,000 is already charged. And you don't show that as a double entry because there's no cash payment in this situation comparing with purchasing of 20 cows. All good?
Yes, sir.
Okay.
Understood.
Okay, good that you're asking questions. Now, any questions from the first 10 questions that we discussed? Now only you come to the, uh, good standards, I would say, asking questions, clarifying doubts. That's really good. No issues up until that. Okay.
I have a question.
Yeah.
Sir, 30th September 2021 වලට ඩයිට් ඩයගේ ෆෙයා වැලියු එක දීලා තිබ්බොත් ඒ amount එකද ගන්න ඕනේ නැත්නම් first එකට එකද?
කැරින් වැලිුවක් ගන්න. ඒ කියන්නේ මෙතන ෆෙයා වැලියු කරන්න හැම මේක දැන් ස්ටෑන්ඩඩ් එකේ කියලා නෑ මොන වෙලාවෙද ෆෙයා වැලියු කරන්න ඕනේ කියලා. දැන් සාමාන්‍යයෙන් අපි කරන්නේ questions වලදී නම් ෆෙයා වැලියු කරන්නේ year end එකේදී. but ඔයාට ඩිසයිඩ් කරන්න පුළුවන් ඔයා monthly fair value කරනවා කියලා. අපි හිතමුකෝ management accounts වලට. එතකොට ඔයාට ඔයා fair value කරගෙන ගියා නම් අපි හිතමුකෝ 30th September වලට ඔයා fair value එක calculate කරලා තියෙනවා කියලා. එතකොට ඔයාගේ carrying value එක fair value එක වෙනවා. එතකොට ඒක තමයි අයින් කරන්නේ. මොකක් හරි figure එකක් carrying value එකේ තියෙන figure එක තමයි ඔයා අයින් කරන්න ඕනේ.
Okay.
පැහැදිලිද මං කියපු එක? ඒ කියන්නේ අපි මෙතන fair value කරන්නේ අවුරුද්දකට පාරන්නේ මේ question එකේ විදියට. එතකොට 30th September වල තියෙන carrying value එක බලලා ඒකයි මම මේ විදියට ලිව්වේ. දැන් අපේ carrying value එක තියෙන්නේ මෙතන 130 million නේ. right 130 million තමයි එක. ඒකෙන් 500න් බෙදලා 20 වලින් වැඩි කරාම තමයි වැඩි කරලා එන ගාන තමයි අයින් කරන්න ඕනේ.
Okay, sir.
හරි. Right. Okay. So shall we take 5 minutes break, guys? So we'll take 5 minutes break, and thereafter we'll move to question number 3 of this paper, that is from earnings per share standard. Okay, so the very important, very good question actually, bit of a complicated question, involves bonus issue, then another bonus issue after the year end. So bit of a complicated question. Let's look at the question after 5 minutes break, only 5 minutes. Right. Let's look at the question number 3. That is from earning per share standard LKS 33. So before starting, one more announcement which I need to make. I mentioned at the very beginning of the session. So this would be the first session, and the second session would be conducted on next Saturday. Right? Seems that we need to have one extra session as well. What I'm going to do is I'm going to take up actually question number 4 and 5 of this paper on Tuesday evening. That means coming Tuesday. So more specifically, if I tell the date, that is on 29th Tuesday 7:30 p.m. We'll have a couple of hours, right, where we'll discuss question number 4 and 5 there, right? Then last section, that is section 3 to 20 marks questions we can discuss on next Saturday at 9 a.m. at the same time, right? Because it takes a bit of a time to explain, because rather than answering, just giving the answer, knowledge is also important. That's why I'm discussing, because these are mock exam. Even the past papers, you should know how to compile the answer, but you need to gather the knowledge, because what's going to be tested in the exam is a different scenario. If you just know just to answer to the question, that's not enough, right? That's why I'm spending a bit more time. Right. Okay. So let's look at this question. This is from, hope you are okay with that. Hope everyone is okay. So that means we have 2 more sessions to discuss this mock exam paper. One would be on Tuesday. That is on 29th, right? 29th Tuesday at 7:30 p.m. to 9:30 p.m. And the last session on Saturday morning, 9 a.m. to 1 p.m. Right? Okay. So then if you have any doubts or anything from the other areas, even you can clarify. Okay, let's read the question number 3. Let's read the question number 3. So always look at the requirement of the question before reading the question. What is the requirement? Compute the earnings per share together with its comparative amounts to be presented in the financial statements of RG for the year ended 31st March 2021. So you have to calculate, compute the earning per share, right? Together with the comparative amounts presented in the financial statements of RJ for the year ended 31st March 2021. Right, let's read the question. Redimax Garments PLC RG is a company involved in sewing and exporting ready-made garments to European countries. Following transactions and events have occurred in respect of its ordinary shares. Roman number 1, paid a dividend of 10 rupees per share for its ordinary shares in issue 1st July 2020 in the form of stock dividends, right? So what is the year end? Year end is 31st March 2021. So the company has paid a stock dividend on 1st July 2020, that is in the during the financial year. So the value is per share 10 rupees. So we need to look at how many new shares have been issued. We'll look at. Then company has issued 500,000 ordinary shares on 1st October 2020. That is at the middle of the year. That is a share issue for cash. Issue price was 175 rupees per share. Shares issued for cash. Then paid dividends of, again, dividend of 10 rupees per share for its ordinary shares as at 1st May 2021. That is after the financial year. After the financial year, another 10 rupees dividends per share, again in the form of what? Stock dividends. Then the shares in issue as at 31st March 2020 and 1st July 2020 were 1 million shares at the end of the last financial year, as well as before making the first dividend payment in terms of the stock dividends. Number of shares issued by the company was 1 million. Market price per share at 1st July 2020 was 200 rupees, and market price on 1st May 2021 was 125 rupees. at the dates, at the 2 dates where the stock dividends are paid, you have been given the market price per share. Net profit of RJ for the year ended 31st March 2020 and 31st March 2021 were 110 million and 125 million respectively. You have been given the net profit for the last year, comparative year, as well as the current year, 110 million and 125 million respectively. RJ had issued 200 million worth of 12% cumulative preference shares on 1st April 2017. Sometimes back, company has issued 200 million worth of cumulative preference shares. Company has the option, issuer has the option to redeem these shares at its discretion. If company wants, company can redeem. If company wants, company can keep the shares. Okay, it's the option of the company to decide the redemption of these shares. In both years ended 31st March 2020 last year and 2021 current year, company declared 12% dividend for these preference shares. Financial statements of RJ. So RG for the year ended 31st March 2021. Financial statements for the year ended 31st March 2021 will be authorized for issue. Authorized for issue on 31st July 2021. That means, board of directors authorized on 31st July 2021 because there's a share issue in terms of a stock dividend has happened after the year end, but before the financial statements are authorized for issue on 1st May 2021. That's why that particular information is given. Okay. Right. So we need to calculate the EPS for the year ended 31st March 2021, as well as we have to show the comparative EPS figure for the last year. That is for 31st March 2020. Now, we know when it comes to EPS, we have two types of EPS, basic EPS and the diluted EPS. In this question, what we require to calculate is the basic EPS. Diluted EPS to be calculated once you have potential owner shares like convertible instruments, convertible preference shares, convertible debentures, stock options. So these are not there in this question. So that what we need to focus is to compute the basic EPS. So in the basic EPS computation, you need to compute the basic EPS by using this formula. That is, my numerator would be profit attributable to ordinary shareholders, or the net profit attributable to ordinary shareholders. So how do you get that? Normally is you get the profit for the year, or you get the net profit. You get the net profit. Out of that, you deduct the what? Preference share dividends you deduct. Then you get the profit attributable to whom? Ordinary shareholders. Okay, you calculate the EPS only from the perspective of ordinary shareholders. You don't need to calculate this for the preference shareholders because their return is fixed, 12% preference shares. Then the shareholders, preference shareholders are aware how much do they get. But ordinary shareholders, they are the real owners of the company. Their return is variable, so that you need to calculate per share basis how much these guys have earned during the year. So that's why we calculate the earning per share for ordinary shareholders. So to get the profit attributable to ordinary shareholders, you get the net profit. Out of that, you deduct the preference share dividends. Right? We need to look at this deduction of preference share dividends in a little while in detail. But by the time being, let's think, okay, this is the way that you get the net profit attributable to ordinary shareholders. Then that has to be divided by weighted average ordinary shares outstanding during the period. There can be changes. There can be new share issues. There can be bonus issues. There can be rights issues. There can be stock dividends. There can be stock split. There can be reverse splits. So the number of shares can change over the period of time. So you calculate the weighted average ordinary shares during the period. So that is your denominator, right? Now in this question, the challenge is to calculate this numerator and denominator. First of all, about the numerator, profit or loss attributable to ordinary shareholders, especially in this question, you have preference shares. Now, when it comes to the preference shares, first of all, you have to understand whether these preference shares are classified as equity or debt, because certain preference shares are classified as financial liabilities. Example, if a company issue a preference share with a mandatory redemption date, Okay. So in that case, on that particular date, it's a must for the company to redeem this preference share. In that situation, the preference share is considered as a financial liability. Okay. So because you have a contractual obligation to deliver cash on that particular date, on that date, you must redeem it. So then, even though they are called as preference shares, these are financial liabilities in the balance sheet. And the dividend that you pay on these preference shares, you have to show that as finance cost. If it is a finance cost, it is already deducted when computing the profit after tax, because I told you earlier, equation here is net profit. If it is a finance cost, when computing the net profit, it should have been deducted. You don't need to deduct it again. If the preference share is classified as a financial liability, you have to remember that particular matter. But if it is otherwise, let's say there can be preference shares which doesn't have any redemption date. Okay, so there's no contractual obligation. Those preference shares are classified as equity. If it is equity, the dividends what you pay, you show in the changes in equity statement. So to get the profit attributable to all shareholders, after deriving the net profit, you need to deduct the preference share dividend separately. Right? You have to deduct the preference share dividend separately. When you deduct the preference share dividend separately, you need to understand there can be cumulative preference shares, there can be non-cumulative preference shares. Non-cumulative mean if you don't distribute the dividends in a particular year, now in this question, it is 12% preference shares. If it is non-cumulative, if it is not declared on a particular year, company is not going to declare that subsequently. Right? But cumulative preference shares means if you do not declare the preference shares in a particular year, it is getting accumulated and it has to be declared in future. Now, because of that, when you take the preference share dividends into the computation, if the preference shares are non-cumulative, if it is non-cumulative, you deduct the preference share dividends only if the dividends are declared, if it is non-cumulative. Non-cumulative only if it is declared. If the preference share is cumulative, that means getting accumulated even though it is not declared during the year, then you have to deduct the preference share dividends even though you declare the dividends or not. Right? Preference shares for preference dividends for cumulative preference shares for the period, you have to deduct whether or not they have been declared. Because why? It is getting cumulative. Okay. Non-cumulative, only if it is declared you deduct. Cumulative, whether it is declared or not, you need to deduct. Are we clear? On the other hand, the first point or the previous point says that dividend paid on the redeemable preference shares considered as debt, for example, are classified as interest and have already been deducted when computing the profit after tax. So no further deduction is required. I have explained, so you can go through what is there in the slides. Now applying to this particular question, the first question now you should answer, right? Now, if you look at this particular question, so the first para of this slide explains this particular preference share. What I wanted to ask from you is this preference share to be classified as a financial liability? If it is classified as a financial liability, dividends are considered as finance cost, and we have to assume that already deducted when calculating the profit after tax. But if it is classified as equity, then from the profit, net profit, you need to deduct the preference share dividends. My question to you is, tell me whether this is a financial liability or whether this is equity. Can you tell me? Hurry up, you need to answer. Financial liability or equity?
It's equity.
It's equity. Any other answers? Yes, it is equity because the redemption option is available to whom? Company. If you look at this, company has the option to redeem. If company won't, company can redeem. If company won't, company can keep it. So there's no contractual obligation, right? So because of that, this is equity. So that is the first decision that you need to take, right? Then thereafter, this particular preference share is cumulative. That means if the dividends are not declared in a particular year, that has to be paid subsequently. So that it doesn't matter whether the dividends are declared or not, it has to be deducted when computing the EPS. But in this particular question, it was clearly mentioned, even though it is cumulative, dividends have been declared at 12% for both current year as well as for the previous year. So that we need to deduct. Now, my point is, if it is cumulative, even though it is not declared, sometimes it can say that it is not declared, but still you need to deduct when computing the EPS. I hope you are clear. Right. Okay, so first of all, okay, so before compute now, let me skip these slides and go to this one. So focus only about this particular computation, working number one. Don't look at anything else because it's easy for me to finish this particular working at this moment because I have already explained that. So you have been given in the question profit for the year for this year as well as the last year, 31st March 2021, 125 million. 31st March 2020, 110 million. It was given in the question, right? Over here. Yeah. 31st March 2020, last year 110, current year 125 million given. So I have taken from there. These two numbers, current year and the last year. Then preference shares have been classified as equity. That means it is not deducted as finance cost when computing the profit. So I had to separately deduct the preference share dividends as it is classified as equity. So the value of the preference shares were how much? 200 million. So it is 12% cumulative preference share dividends. So 200 million into 12%. How much? 24 million to be deducted as preference share dividends each year. Preference share dividends 200 million into 12%. 200 million into 12%. 24 million. Right? Clear. Then you get the numerator. This is the numerator, profit attributable to ordinary shareholders for the year ended 31st March 2021, 101 million. For the last year, 31st March 2020, 86 million. So here it explains company has the option to decide the redemption of preference shares and dividend payment will be made at the discretion of the company. Therefore, there's no present obligation on the redemption of these preference shares. Okay. Accordingly, these shares have to be classified as equity and the distribution should be adjusted in equity. So dividend payment is shown in the changes in equity statement in the retained earnings column. Hence, this should be reduced from the profit for the year when calculating the profit attributable to ordinary shareholders. Are we clear? Right. That is done. Now the numerator part completed. Now the challenge, denominator, weighted average number of shares. How to calculate the weighted average number of shares? What you do is there can be share issues, there can be share repurchases. First of all, shares can be issued for cash. In the particular question, 500,000 shares have been issued for cash, right? In the middle of the year. So those shares, so when you make a share issue, what is the impact on earnings? Always think share issue impact on earnings because we are calculating the EPS. Denominator is the number of shares, numerator is the earnings, profits. So because of that, relate the share issue with the earnings impact. When you issue new shares for cash, there are additional resources coming into the organization. So these cash can be invested in the business and that can be utilized to generate profits. Right. So because of that, if the shares are issued on a particular date, so in this case, so there were, if I look at the question, you look at this question here, Roman number 2, 500,000 ordinary shares for cash. on 1st October 2020, middle of the year, issued at a price of 175 rupees per share. So you get cash by issuing these shares, and this cash is invested in the business on 1st October 2020, and that contributes to the earnings generation of the business from this date onwards. So because of that, when you calculate the weighted average number of shares, you have to take the share issues and the repurchases with the corresponding resource change, with the corresponding impact on the earnings from that particular date of change. So that means shares issued for cash is taken to the computation prospectively from that date. So in this case, from 1st October 2020 onwards. Similarly, company can repurchase their shares. Okay, company can buy back their shares for cash, right? So then the repurchased shares are taken out from the computation from the date of repurchase, because when to repurchase shares, company has to spend cash. Then when company incur cash to that, the amount that they can invest in the business is reduced. There's a negative impact on the earnings. So the repurchase shares are taken out from the computation from the date of repurchase. That is what is explained in this particular slide. Shares issued taken from the date of issuance. Reacquired shares are excluded from the date of reacquisition. That is shares issued for cash. But there can be situations where number of shares are getting changed without a change in the corresponding resources. Example, bonus issue. You issue shares to the existing shareholders for free. Number of shares will increase. No resources are coming into the organization. No impact on the earnings. Share dividends. Dividends are paid by the company not by using cash but by issuing shares. Again, when the dividends are paid by issuing shares, number of shares will increase, but no resources are coming into the organization, no impact on the earnings. Then there can be share split. Let's say if you believe that the share price is too high, liquidity is less, transactions are less, you can split the share. One share you split into 10. The number of shares will increase. Again, there's no corresponding increase in the resources. So whatever the event where the number of shares have been changed without changing the corresponding resources, which doesn't have an impact on the earnings capacity, is adjusted retrospectively when computing the weighted average number of shares. What do you mean by retrospectively? Irrespective of the date of the change, it can change on the first day, it can be changed in the middle of the year, it can be changed at the last date of the year. You take this impact retrospectively, which means entire year. You believe that this change, you assume that this change has happened from the beginning of the financial year. Not only that, even the change, the impact you need to take for the comparative years as well. So now for an example, let's say if there's a bonus issue, or if you have share dividends where the number of shares are getting increased without increasing the corresponding resources. So these bonus shares are to be taken to the computation from the beginning of the year. Even the last year numbers are to be adjusted with regard to this bonus issue, because you can't ignore them, as well as you can't consider them prospectively, because taking something prospectively means from that date onwards there should be an impact on the earnings generation capacity of the company because of the change in the resource level of the organization. Are we clear? So the bonus shares as well as share split, dividends, share dividends are to be taken. Assume that those change have been happened at the start of the year. Even the comparative figures are restated. So we look at with the question. Right. Now, I want to compute, the question is to compute the current year and the comparative year EPS. So if you look at the top most of this slide, first line says EPS for the year ended 31st March 2021. Numerator, I have already computed by using working number 101 million. I now need to calculate the denominator. What should be the denominator? Weighted average number of shares. Look at how should I calculate the weighted average number of shares. I have to have a table. I have to have a table. So look at this table. First column is the date, then the number of shares. You have to have the time weighting factor. Then there's a column called bonus fraction, which is required for bonus issue, stock dividends, right? Stock split, then even a rights issue. You need this column, bonus fraction, then the weighted average, right? So now start from the beginning. So this is the current year. So the period is what? So the current year means 1st April 2022, 31st March 2021. This is the period, no? Starting from the beginning of the year, 1st April 2020, up until 1st July, as per the question, up until 1st July 2020, there are no changes in the number of shares. As per the question here, if you look at the Roman number 4, shares in issue as at 31st March 2020 and 1st July 2020, up until 1st July 2020, 1 million shares. So that means up until 1st July 2020 means during the current financial year, how many months? 3 months, right? April, May and June. The number of shares was stayed at 1 million shares, right? 1 million shares were there for how many months? 3 months. For the time being, forget about this bonus fraction and the weighted average column, right? Just focus on the first 3 columns. Then what has happened? That is on 1st April 2020 to 30th June 2020, 3 months. Then 1st July 2020, there's a change. What was the change? If you look at the question, what was the change? Here, company paid 10 rupees per share. But this 10 rupees per share is paid not by using cash, but by issuing shares. Instead of paying in cash, company has issued additional shares to the existing shareholders as dividends. So we need to calculate how many number of shares have been issued as the stock dividends. So to calculate that, we should first of all calculate what is the total value of the dividends. Easily you can calculate, right? Because how many shares were there? You had 1 million shares, no? Right? By 1st July 2020, before this stock dividend has been happened, 1 million shares were in issue. So what is the dividend payment? 10 rupees per share. So that means what? How much you need to pay? 10 million rupees you need to pay as dividends. Am I correct? You have to pay 10 million rupees as dividends. But you don't pay this 10 million in cash. You pay this by issuing shares. To decide how many shares have been issued, you should know what is the share price on 1st July 2020. So what is the share price on 1st July 2020? Where do we have that information? Where do we have that information? Over here, if you look at the Roman number 4, the second line, market price per share on 1st July 2020, 200 rupees. Then 1st May 2021, subsequently 155. Right, to decide how many shares to be issued, what is the market price per share? 200 rupees per share. So 1 million is the total amount of dividends to be paid. Sorry, 10 million. 1 million shares, 10 rupees each. 10 million is the total amount of dividends to be paid. Per share price on 1st July 2020, 200 rupees. So how many shares to be issued? 10 million divided by 200. How much? 10 million divided by 200. 50,000 shares. 50,000 shares have been issued as stock dividends. Number of shares will increase, but without corresponding change in the resources. No resources coming into the company. No cash inflow. That means there's no contribution of the earnings generation of these new shares. So those type of shares, what I said, you need to adjust retrospectively. You have to go back and make the adjustment. Even the first 3 months, I have to assume that these shares were there, always there, right? So what I do is look at this. Now that means number of shares will increase to 1,050,000 on 1st July 2020, right? That is 1 million shares that was there plus additional 50,000 shares. Here even I have mentioned how these 50,000 shares have come, right? As a working stock dividend calculation on 1st July 2020. What I have shown earlier, the total amount of dividends declared 1 million shares, each share 10 rupees. So the total amount of the dividends in value 10 million rupees. Share price on 1st July 2020, 200 rupees. So the 10 million dividends total value divided by 200 rupees, you have to issue 50,000 shares. How did you get this 1,050,000 over here in shares? 1 million plus this 50,000, 1,050,000 shares. Okay. Then, so it was at 1,050,000 level up until you do the next share issue for cash on 1st October 2020, because 1st October 2020 it was mentioned that, so there's a share issue for cash, 500,000 shares have been issued for cash. So that means from 1st July 2020 to 30th September 2020, for 3 months period, 3 upon 12, number of shares are at the level of 1,050,000 shares for 3 months. Okay, for 3 months. Is that clear? Is that clear? Then when you have a share issue or change in the number of shares without change in the corresponding resources, you need to immediately calculate the bonus fraction to do the retrospective adjustment. To do the retrospective adjustment, you need to calculate the bonus fraction. How do you calculate? So the working number 4 says bonus fraction is calculated by taking the number of shares after the change divided by the number of shares before the change. Now in this case, what is the change? Stock dividends. You take number of shares after the stock dividends, which is 1,050,000 shares, divide by number of shares before the stock dividends. Before the stock dividends, it was 1 million shares. 1,050,000 divided by 1 million. So once you simplify, the bonus fraction would be 21 over 20. 21 over 20. Then how do you make the retrospective adjustment is, you go to all the periods prior to this particular, so this is the particular change. So this is the particular change in which this 50,000 shares are included. You go to all the periods prior to this date and multiply those periods by the bonus fraction. Now you just have only one change before the stock dividends are paid. So you go there and multiply that by the bonus fraction. Actually, by doing that, what do you do? Now you just, if you take the first period, how many shares were there? 1 million shares were there in the first period, right? So this particular figure, 1 million. You multiply that by the bonus fraction. Multiply it by 21 divided by 20. What is the answer? 1,050,000. What do? You make this 1 million into 1,050,000. So basically, even the first 3 months, you take your number of shares at 1,050,000. First 3 months, 1,050,000. Even the second 3 months, it is now what? 1,050,000. Did you understand my point? So you converted 1 million into 1,050,000. 1 million into 1,050,000 by multiplying 1 million by this bonus fraction. That's what you did. So that is what is meant by retrospective adjustment. You do that retrospective adjustment through the bonus fraction. I hope you understood. I hope you understood. Right, clear. Then what will happen as per the question? On 1st October, over here, if you look at the Roman number 2, 500,000 ordinary shares for cash. That is for cash. There's a resource inflow. So it contributes the earnings generation from 1st October 2020. This has to be adjusted prospectively, right? So the issue price was 175 rupees per share. So the number of shares will increase by 500,000, right? Number of shares will be increased by 500,000, which means from 1st October 2020, middle of the year to the year end. What is the year end? 31st March 2021. So the number of shares will increase by 500,000, 1,050,000 plus 500,000. It would be 1,550,000. So the number of shares are at that level up until the year end. That means for 6 months period up until the year end, 6 upon 12. Okay. Now focus on the final column, weighted average. 1 million into 3 upon 12 into bonus fraction, 21 over 20. 262,500. Then the second period, 1,050,000 into 3 upon 12, 262,500. 1,550,000 into 6 upon 12, 775,000. Add them together and get the figure. What is the weighted average number of shares? 1,300,000. So this is my denominator. Are we okay with that? 1,300,000. Then, okay, I need to compute my EPS for the year ended 31st March 2021. I have taken the numerator, which is profit attributable to ordinary shareholders, 101 million, taken from working number 1. Then the denominator should be weighted average number of shares, which is how much? 1.3 million. But in this question, you have an additional complication. What is it? Before that is next year. So the next year means what? What is the next year? Next year would be, if you look at the next year, starting from 1st April 2021 onwards. That is the next year, right? Now next year, what has happened was, before the financial statements are authorized for issue on, if I go back, here it was mentioned, if you look at the Roman number 3, paid another 10 rupee per share in way of stock dividends as at when? 1st May 2021. You have made a stock dividend of 10 rupees per share in the next year. And it was mentioned in the question where the financial statements are authorized to issue. 1st May, you have paid this stock dividends 2021, where the financial statements got authorized to issue 31st July 2021. Now, yet again, this is a change in the number of shares without corresponding change in the resources, right? It has to be adjusted, but retrospectively. But that would be happen in the next year, but that has happened before the financial statements are authorized for issue in the current year. So this has to be considered as an adjusting event. So which means you need to calculate how many number of shares are issued without changing any corresponding resources in the next year. Take that number and include that in the computation of the current year. You have to do that. Okay, you have to do that. So now if I look at this, so the next year means, now if you look at the next year, starting from 1st April 2021, right? This is the starting of the next year. Or this is actually year end is falling on 31st March 2021 in the current year. Then my financial statements are authorized to issue as per the question 31st July 2021. Financial statements are authorized for issue. In between, what has happened somewhere in 1st May, during this period, there's a stock dividend share issue. Okay, 10 rupees per share. Now, how many shares are outstanding by the year end? By the year end, altogether, how many shares are outstanding here? When it comes to the current year end, 31st March 2021, how many shares are there? 1,550,000 shares. So if you have actually, I would say at the end of the current year, I have 1,550,000 shares in issue, right? On this particular date, 1st May 2021, as mentioned, we have a stock dividends. There are how many shares to be issued? How to calculate? How to calculate? 10 rupees per share. 10 rupees per share mean 1,550,000 shares are outstanding. Per share 10 rupees. Which means what is the value? It would be 15,500,000. Am I correct? 15,500,000. This is the value of the dividends. This is the dividend value. This is the dividends are paid not in way of issuing, sorry, not in the way of paying cash, but in the way of issuing shares. Dividends are paid not in the way of cash, but in the way of issuing shares. To decide how many shares have been issued, you need to know that on 1st May 2021, what is the share price? What is the share price on 1st May 2021? If you go back, Roman number 4, share price on 1st July 2020, 200 rupees, 1st May 2021, 155 rupees. So easily now you can calculate how many shares to be issued. So the total value of the dividends are to be paid 15,500,000. Value per share 155 rupees. So 15.5 million divided by 155 rupees. So how many shares? 100,000 shares. 100,000 shares will be issued on 1st May 2021. That is in the next year, but before the financial statements are authorized to issue. So now this 100,000 shares are adjusted retrospectively. The reason is this increase has come without any corresponding change in the resources. No impact on the earnings. No cash inflow is happened. So you have to adjust this retrospectively. That means you have to go back to the previous year. That means our current year and add this 100,000 into the computation of earning per share. Now this particular 100,000 is shown over here as well. Stock dividends on 1st May 2021. Dividend to be declared, we have 1,550,000 shares, per share 10 rupees. So that means altogether total dividend value 15,500,000. To calculate the number of shares issued, you take 15,500,000 divided by 155 rupees per share. So how many shares are issued? 100,000 shares, right? So that we have already calculated. So what I need to do is in the EPS computation, under working number 2, I have received this weighted average number of shares the current year, 31st March 2021. This is for the current year, 31st March 2021. Weighted average number of shares, 1.3 million. To that, you need to add the number of shares issued without changing any corresponding resources, which require a retrospective adjustment as these shares have been issued in the next year before the financial statements are authorized for issue. So my denominator would become actually 1.3 million, 1,300,000 plus 100,000 altogether. My denominator is 1.4 million shares. 101 million rupees divided by 1.4 million shares. What is my EPS? My basic EPS in the current year 72.14, 72 rupees and 14 cents, 72 rupees and 14 cents. Are we clear? Are we clear? Understood? Right. Yeah. Then what about the comparative year? Because when it comes to the current year, now current year is 31st March 2021. I say current year earning per share is 72 rupees and 14 cents. So with the current year, I have to show the comparative numbers, right? Now let's say this is my financial statements. My financial statements. Okay. Have a space here, right? This is my financial statements. 31st March 2021, year end. I say my EPS. How much is that? Rupees 7214. With this, I have to show the comparative number. Comparative number is 31st March 2020. Sorry, 2020, last year. I have to show the comparative EPS. What is the already recorded EPS? Let's assume I was at the last year, 31st March 2020. At that time, when I was preparing the financial statements, what would have been the EPS recorded? My profit attributable to ordinary shareholders, I know, 86 million. 86 million. Right? 86 million. Then how many shares were there? If I go to this, at the beginning of the current year, how many shares were there? 1 million shares. That means if I assume that there are no changes in the number of shares in the last year, year ended 31st March 2020, I can assume that, okay, last year, number of shares were 1 million, right? Last year means 31st March 2020, number of shares 1 million. So the recorded DPS, okay, recorded DPS would have been, right, 86 million over here in terms of rupees, divide by weighted average number of shares would have been 1 million. So recorded DPS is 86 rupees per share. 86 rupees per share, that is in the year ended 31st March 2020. But when you present the financial statements for 31st March 2021, and when you show the comparative EPS, that is 31st March 2020 comparative EPS, can you show that as 86? No, this has to be restated. This has to be restated for all the adjustments which you need to make on retrospective basis. Now we looked at this question. So what are the adjustments that you need to make on retrospective basis? If you look at the current year, first of all, in the current year, so if you look at the second period, 50,000 shares have been issued as stock dividends. In the current year, 50,000 shares have been issued as stock dividends in the current year. That is increase in number of shares without corresponding increase in the resources. So that has to be adjusted retrospectively, mean even this 50,000 shares to be taken for the previous year, 31st March 2020. You have to take that. Right? Retrospective means you need to go back and adjust. Assume that 50,000 shares have been issued from the beginning of the current year. Not only that, it was there in the comparative years. You have to assume that these 50,000 shares are always there. Not only that, next year, that means my current financial year is over by 31st March 2021, but in the next year, before the financial statements are authorized to issue, another 100,000 shares have been issued. Another 100,000 shares have been issued as stock dividends. Again, increase in number of shares without corresponding increase in the resources. So this also to be adjusted what? Retrospectively. Retrospectively means you need to go back and adjust. So this 100,000 actually you looked at earlier, that was considered in the computation of the current year EPS, 31st March 2021. So this 100,000 actually you have to take even not only 31st March 2021, even the prior year, 31st March 2020. So actually you have to do two retrospective adjustments, and you need to restate the EPS what you have calculated for 31st March 2020 by taking the stock dividends which have been paid in the current year and which have been paid in the next year before the financial statements are authorized to issue. So in the current year, 50,000 additional shares. Next year, before the financial statements are authorized to issue, 100,000 shares. Altogether, how many shares? 50,000 plus 100,000, 150,000 shares to be adjusted retrospectively, which means when I'm calculating my restated DPS for the year ended 31st March 2020 in the 31st March 2021 accounts, what I have to do is my numerator won't change, that is 86 million, that's not going to be changed, 86 million, divide by, at that time it was 1 million, but now when I'm restating 1,150,000, which means 1 million plus 50,000, that is current year stock dividends, plus 100,000 next year stock dividends before the financial statements are authorized to issue. What is the value? Rupees 74 rupees and 78 cents. So then if you look at the EPS trend compared with the last year, it has come down. Last year my comparative figure 74 rupees and 78 cents, current year 72 rupees and 14 cents. Okay, that is mentioned here. You look at this EPS in the financial statements for the year ended 31st March 2020. That is my comparative year. Earlier it would have been 86 rupees, 86 million divided by 1 million shares. This is restated in the financial statements for the year ended 31st March 2021. Restated comparative is therefore 74 rupees and 78 cents. That is 86 million divided by 1,150,000 shares. Okay, so this particular theory I have already explained to you. What is it? If the number of ordinary shares outstanding increases as a result of the bonus issue, share dividends, share split, calculation of earning per share for all period presented should be adjusted retrospectively. You assume that it is always there. Then the last point is, if these changes occur after the reporting period but before the financial statements are authorized for issue, that this is the stock dividend which has happened on 1st May 2021, then the per share calculation for those, that means current year and any prior periods financial statements presented, should be based on the new number of shares. So that means if the shares are issued after the year end before the financial statements are authorized to issue, current year EPS and the comparative EPS, both you need to take that into consideration if it requires a retrospective adjustment. If it requires a retrospective adjustment because the number of shares has been changed without changing the corresponding resources. Remember, always retrospective adjustments are required only for the change in the number of shares without changing the resources. If the number of shares has gone up with the resource change, with the impact on earnings, don't adjust retrospectively. Example here, you have issued 500,000 shares on 1st October. Okay, you have issued 500,000 shares on 1st October 2020. You have not adjusted that retrospectively. You have taken that prospectively because that contributes to the earnings generation from that date only. No need to adjust retrospectively. So in this question, we discussed the matter with regard to a stock dividend. So the same scenario is applicable with regard to a bonus issue, right? And also here, there's no involvement of a rights issue. But if you look at the past paper question, last time past paper question, that is July 2022 paper. So you had a question, it's a EPS involving a rights issue. But in this question, EPS involving a stock dividend, right? So in the last time paper, you had a rights issue and you have a split, stock split, share split. Okay, so this explains, actually these two questions explain the entire story of EPS. So complex question, but understand the logic correctly. Then you can answer. Okay, right. Yeah, so we are done with that question. Any questions that you need to clarify? Do you understand? Hope you are, right. So as I mentioned, so we took actually close to 4 hours, but hope this session was effective, helpful for you all. Right, so as mentioned, what we can do is question number 4. We don't have time today to discuss this. Question number 4 and 5, we'll take it on Tuesday. So Tuesday means specifically the date. On 29th, I'll start the session at 7:30 p.m. Go up until 9:30. We can take these two questions there. Then the question number 6 and 7, that is two complex scenarios, consolidation question and the accounting standards question. We'll take it we'll take it on next Saturday. Okay, next Saturday at the same time, 9 a.m. So if I look at this mock exam paper, one find which I can say is, so you don't have a question from SLFRS for SMEs. Normally, if you look at the if you look at the past papers, question number 2, or else you have a 10 mark question from SLFRS or SME, but in this mock exam paper, you don't have a question from SLFRS or SME. So that is also an important area in terms of the examination. But the other areas, what is normally tested is available here, because question number 4, professional ethics, question number 5, financial statement analysis. Then the section 3, 220 marks questions. One is from the consolidation, one is from the accounting standards. Right, so that's it for the day. So if you have doubts, please clarify, or else we can make a conclusion. Hope you enjoyed the session. Right, so let me know your suggestions. So was it helpful? You get the knowledge?
Yes, sir.
Yeah, let me know your comments as well in the chat box. That is important when we arrange in the future sessions. So this is something CS Sri Lanka is doing for the benefit of the students. So they also want to get the comments. So let me know your comments in the chat box, right? Tuesday session starts from 7:30 p.m. in the evening, go up until 9:30 p.m. Okay, right. So yes, please let us know your comments, right? It's really important for the me as well as the institute to get this feedback from the students when arranging the future sessions. Right. Recording upload is done by say Sri Lanka. They will do it soon, right? They don't take that much of time. They will do it very fast. But ensure that you present for the next 2 live sessions as well, right? That's important.